Ladies and gentlemen, welcome to the Midday Market Madness. Today is a little bit different of a day. As you guys can see, the time has been changed. That's because there are three conferences, and I'm going to be listening to all of them. So this is going to be a little bit of a listen along. However, I'll give you guys the times now in case you guys want to leave or come back, depending on the types of conference that you want to see. So let me sort of break down how today is going to go right now. And I'm talking in Eastern Standard Time. So please adjust to whatever time frame you're in. But right now it's 1 p.m. Eastern Standard Time at 2:15 p.m. So for the first hour and 15, I just want to go through the regular news, everything that we're seeing there. At 2:15, we have the Shift4 conference. They're doing a fireside chat. At 2:55, so about almost 2 hours from now, there'll be the Chime conference. And then at 3:35, okay, about 2 hours and 35 minutes from now, we have the SoFi UBS AI conference for SoFi. Okay. So those are the three listen alongs. They're all going to be about 30 minutes or so. In between that, we'll be following the news, anything that's happening, stuff like this. Okay. It might go a little bit longer. Usually I try to wrap up the stream around 3. I think this one we're going to have to wrap up around 4 o'clock, just because the SoFi Fireside chat is going to be, sort of in that space. All right. Hopefully you guys have those times. If not, maybe I can just pin a comment or something so we know sort of when to come back. That being said, we've seen a lot of interesting news from some of these fintech names. Let's take a quick peek at the markets just so we know what is hot and what is not. And then we can get back to the fintech cult news that we all want to hear about. Okay, the SPY is up 0.37%, 684 on the SPY there. And then the Qs are at 623, 623, and up 0.16% on the day, giving maybe a little less performance on some of the bigger tech names. It's usually what happens whenever the the triple Qs, the NASDAQ, is lower than the SPY. It's usually because there's a sort of a technology difference there. The Nubank stock has been on quite a journey recently. This stock ended up hitting $17.84 as of yesterday, which was an all-time high for the company. Not intraday, as you can see, there's quite the spike, but in the actual trading days, this company has been on quite the journey over the last year, up 48%, year to date up 68% roughly. And this is a name, as many of you guys know, it's one that I've been following for a very long time. And a bunch of people have told me, oh, this is a dead stock. It continues to go nowhere. The investing in LATAM has sort of just worse upside than US companies. Well, here Nubank is in the 17s, and we're going to 20, baby. We're going. Every single quarter, they end up posting bigger earnings. This is why from yesterday, there was comments about, hey, set a price target on a company. Whenever that fulfills, sell it. Well, at what point over my journey of holding Nubank, which just has absolutely crushed the S&P 500 for me, buying from 380 up to 1740, at what point should I have set that price target and sold? Has it in certain timeframes, if you were to select certain months, has it stayed stagnant while other companies have ran? Yes, but I'm not smart enough to sort of predict that, right? So once again, if you guys find a company that continues to outperform the broader indexes, that continues to outperform, and I don't necessarily just mean that on a stock price. I mean, in terms of the amount of revenue growth, going down to margin, making smart plays, new customers are coming onto the platform, high NPS scores, people are like very, very happy to use the platform and they continue to expand. Why would I ever set a price target on this? I mean, I'll be happy to hold Nubank I got to be careful. They're an $84 billion company, but like, in the long term, I could see this doubling, tripling, quadrupling if they just continue to operate over time and just continue to improve. Why would I ever think about selling this name and buy something else? They have just like proven that they are outperforming, and there's a cultural difference to this company. Okay, that's my spiel on finding good names and sticking to them. IREN up 6.7%, 43.93. Bullish up 6.6%. That's pretty bullish. 45.90, sticking to their name. Vertex is up 6.2%. Shark Ninja, which honestly, this one's been a hard hold the last little bit. Tariff talks, everything like this has dragged this stock down. Since, late November, we've just completely turned course from essentially $85 back up to $107.75. It's felt good, I have been wanting to trim Shark Ninja, but I haven't made that decision just yet. And so who knows? Maybe if we continue with this momentum, we'll hit new highs, and then I can look to get out of it. Not because I don't believe in Shark Ninja. It just doesn't match my portfolio. I want the AI names. I want the innovative tech. They're doing innovative things in, consumer small appliances, but not quite what I'm looking for. But that's fine. Amcor 43, another amazing run here. Galaxy Digital up 5.5%. Robinhood, massive news today on Robinhood. Vlad Tenev just recently posted. Let's take a look at this. I also tweeted about this because I thought that this was just amazing. Welcome to Robinhood app. All the Tesla shareholders who just recently transferred $1.4 billion to Robinhood with an average account size of over 500,000. A clear signal that people want choice, speed, and innovative tools that help them make their voices heard. Part of that, and what he's talking about being having their voices heard, was that they, if you transfer over at least one Tesla share, you can get an uncapped 2% bonus on shares that you transferred over to Robinhood. The interesting part about this is they did this because there were some sort of voting constraints with these funds and different brokerages. So the funds were the like passive indexes, like index funds that essentially had a ton of Tesla in them, but they themselves, if you were an owner of those funds, you were not selecting whether or not Elon could have his pay package. Robinhood was like, okay, well, we're not going to let a brokerage decide whether or not they're pre-selecting. Schwab is pre-selecting who is going to want Elon to have his pay package or not. Come to Robinhood. We will let you vote. We'll let you have your voice heard. And in fact, we'll pay you 2% to transfer over. Now, clear signal that people want choice, speed, and innovation. I think also maybe a clear signal, if I'm just being fair, that people wanted an extra 2%, right? There's a percentage of people who transferred over their money that wanted a quick hit, that wanted a quick 2%, and we need to realize that. However, as I said in my latest tweet, that they might come for the 2%, but once they actually feel the product quality of Robinhood, the speed of innovation, maybe the 2 years that they have to even stay there to accept that 2%, they're going to see so many new products be released to Robinhood, and that is going to make you stay. Okay. But another thing too is, if you guys remember, I don't remember the exact article that came out, but there was an article that stated that Robinhood's average account balances were roughly about $400 per share, which was true, but it wasn't consisting of a bunch of people who had just $400. It was a lot of like nascent or dead accounts and then some much larger accounts there as well. Anyway, the average account size going to Tesla most recently. So right now, the average account size, I think, is around 12,000 assets under management for Robinhood across all accounts, the 27 million people that they have. The most average new account to transfer over recently is about 100,000. And then as of this most recent month, now they're saying the average account size for this transfer was 500,000. This is a massive acceleration. Like, I'm a very, very proud Robinhood shareholder. And another one, where would you set the price target on Robinhood? What seems fair if you're going to hold this for multiple years? So I don't have price targets set for these types of businesses. It did feel like it ran up pretty quickly whenever it got to 150, but that was just a sort of a gut feeling of too fast, too soon, right? So yeah. Oh wait, did this really happen? Oh my gosh. Hold on, guys. Yeah, is Jensen really on the JRE? I'm seeing multiple people post about this. This is crazy. Yep, it happened. Posted 12 minutes ago. Are we allowed listening to this? Am I allowed listening to that? What's the policy on Joe Rogan? I know you're saying yes, but I don't actually. It's really account, like it's on a per account basis. He has the complete right to pull me down. Okay. But there are some creators that just completely want exposure. For example, Mr. Beast, you're just allowed to watch his content. We could watch a full Mr. Beast video, even though he's the most popular person on YouTube. He just said he'll never copyright strike anyone because he wants everyone to listen to his stuff. So, yeah. Rogan is very protective of IP. Okay, thank you, Kyle. Because honestly, I'm looking and I'm not seeing a lot of videos about Joe Rogan from other accounts, which is, one of the big signs that he's pulling them down. So I'm going to hold off on that. Definitely going to have to listen to that. What bad timing for my stream. Okay. That being said, I'm sure we'll see some quotes that get posted on X. I'm going to keep you guys updated as those pieces come in to see if Jensen had said anything. Right now, it's a 12-hour and 30-minute podcast. We're 12 minutes since it's been published. So we're not going to see the quotes just yet, but I'll keep you guys up to date. Let's go ahead and talk about Shift4 really quickly. I'm going to keep this extremely brief. We are listening to their conference, but yeah. Liberty Sports Group and Front Row Hospitality announced multi-year partnerships with Shift4 to power commerce across sports, entertainment, and hospitality properties. Once again, Shift4 landing big deals. Okay. We'll provide their SkyTab venue technology for integrated point of sale and guest experience solutions, and will also power payments for merchandising, retail, e-commerce operations across Liberty's managed venues and client partners, and e-commerce operations. This is a unified commerce customer. There's not many. That's very exciting. Merchandising, retail, and e-commerce. That's unified commerce. Okay. This is where they have the highest take rate. This is a full customer. This is very, very exciting. Shift4's platform helps us unify every part of the fan experience while enabling our clients to operate more efficiently and profitably, said Joe Scott, Vice President of Growth and Strategy Partnerships at Liberty Sports Group. It's a natural alignment of technology and hospitality that strengthens our ability to serve partners at the highest level. We're proud to partner with Liberty Sports Group. Okay. Any numbers? Do we have any numbers? No numbers there. However, if we go back, there was another piece of news that we didn't cover. I only said it very, very quickly in one of my live streams recently. But they did end up having another stadium that was a Canadian stadium, which was their first stadium for a Canadian sports event. Shift4, the leader in integrated payments and commerce technology, has been selected by the Ottawa Senators to power food and beverage concession payments for the team's home games at Canadian Tire Center. Gosh, we really like Canadian and proud. Also, I'm sorry, guys. I know I'm Canadian, but you guys know I'm not a sports guy. I did not know that the Ottawa Senators was a thing. And what a terrible sports name that is. The Ottawa Senators? A bunch of politicians on the ice? No, man. Not liking that. But hey, that's all right. I've seen the hand in your Canadian passport. I know of Canadian Tire. I've got Canadian Tire. I don't watch any sports though. I actually just saw World of Statistica. Is it Statistica or Statistics? World of Statistics, maybe. But they just said that the most loved country in the world is Canada. And here I am. I just crap talk it every day. It's like, let's see where they posted that. Youngest billionaires, Mark Zuckerberg at 23. What am I doing with my life? Submarine strength, fleet strength by country, United States was 70. How many does Canada have? We're not even on the list. We're just piggybacking on you guys. We appreciate it. Okay. I don't remember where it was, but pretty awesome. Oh, yeah. Most loved country in the world. There it is. Singapore. You know what is crazy? The United States, not even here. Canada, Norway, Sweden, Switzerland, Australia. Everyone else loves Canadians except for Canadians. No, there's a lot of Canadian pride. But yeah. Apple all-time high? Yeah, they've been hitting a lot of all-time highs lately. What are we at? 289 or something? 285. Little quick drawback, but they did. It was this morning, 288. Sorry, I thought you meant another new one. 288 was this morning. We're now at 285, but yeah, we need to get to 289 to hit another one. The Shift4 conference is today. That's at 2:15. It's going to be the first one. We're going to have a listen to that. Currently, the stock has been recovering. We're at $71. Okay, 73 this morning. And over the last sort of 5 days or so, I mean, we're kind of flat. We were actually much higher a few days ago. On December 1st, we were $75. But yeah, a little bit of a recovery. I still have a lot of faith in that name. I continue to hold. Ethereum is up 4% to 3,100. Yes, the Fusaka upgrade is today. SoFi's at 3:35 p.m. Eastern Standard Time. Okay. But the Fusaka upgrade, in my opinion, what is that? Oh, you guys are going to need to help me. The effect of whenever a price goes down, it brings up utility and actually increases the total amount of payments. What's that called? The people brought it up, like Satya Nadella brought it up a lot during the DeepSeek moment. That whenever something's cost goes down, it I don't remember. Whenever I see it, I keep wanting to say the freaking Durbin Amendment. I know it's not Durbin. The Reckoning. The Fusaka upgrade was Laffer curve. I mean, that might also be true, but it's definitely not Murphy's Law. Murphy's Law is something's bound to go wrong. It will, right? Jevons Paradox. Thank you, Nick. Mwah! What a beauty. Jevons. Yeah. You're right. That's it. Anyway, that to me is what I think is happening with the Fusaka upgrade. Many people are worried that if we're continuing to lower the gas fees and allowing more total transactions to happen on Ethereum, that's just going to lower the total amount of burn that can happen on Ethereum. But not not really what I believe is going to happen. I just think that it's going to bring a lot more utility. But essentially, there's a bunch of really technical stuff in the Fusaka upgrade, like the way that they actually are able to block read information and sample the information to understand. Like, I don't get it all. Okay, the main part is that the actual Ethereum mainnet transactions are cheaper. It allows for bigger and faster L2s. That also happens. And there's some new protocols that allow for new accounts to be verified and increasing security. That's the main part. We're trying to sync SoFi before the fireside chat. No, I mean, we're flat on the day. It's fine. It is fine. JP Morgan, also flat on the day. Ives ETF, the AI ETF, that's flat. A lot of these really interesting tech names that a bunch of people have been giving up on have been seeing a little bit of a premium lately. ServiceNow, MongoDB, Adobe. There might be some really interesting plays here as well. Salesforce, they have earnings tonight. SentinelOne up 1.2%. They have earnings on Thursday. Tomorrow, I mean. So that's quite cool. We have tonight we have Salesforce, Salesforce, Snowflake, UiPath, C3 AI, Five Below, stuff like that. Tomorrow we have Rubrik, SentinelOne, DocuSign, HP. So some other interesting names there. Names that are really running: Circle up 9.4%, Air Test Systems up 9.3%, Wix up 6.8%. And then what's not working, GitLab down 13.6%, Beyond Meat down 8.5%, selling off from that quote unquote short squeeze that happened. Not quote unquote. I mean, it was up like 50%, but still heading back down. Netflix down 5.3% on the idea that the Warner Brothers deal is happening. Guys, this is why, I sort of have a hard time. I'm not saying that Netflix is a bad trade, okay? We were talking about Mary yesterday. She's been investing in this company since 2010. I think she's up like 12,000%. But my problem with this is, I was listening to Amit, and he said, no, the Warner Brothers deal is good because they need more content. But it's to me, that doesn't sound like that sounds like a weakness. They constantly have to look for more content to engage users, have them stay on the platform. And so to pay, what was it, 30 billion or whatever? What's the floated number now for Netflix? To pay for that just to get more content. It's okay. And then how long is that going to last? Then do you need to do that a couple, like every 5 or 8 years or something to just make sure that the people are happy with your selection? So I actually am with the market a little bit. I think it's a little bit of a sell-off on that news, because are you going to be able to raise prices because you have a wider selection of content? Maybe, but by how much? By 10%? They have way too much content? No, in my opinion, I don't think they do. They make a bunch of their own stuff, which is good. That's very good. I very much like that. But then there's been some sort of complaints as well with their own stuff, that it's all sort of 6 out of 10 content, and that they're willing to shell out. How much did they Amit was talking about Friends. I'm pretty sure the renewal of Friends on Netflix was something like $200 million deal or something. Like it's insanity. But yeah. Um, I live in Hawaii and I know about the Ottawa Senators. All right. You're a sports guy. Yeah, in my opinion, YouTube is just like, what a model. You know, you never have to worry about content because you've empowered the users to make that content. Now, I also think that Netflix has so many users and that they could go down that road as well. And they've already have, right? Like they started paying some YouTubers like KSI to make that Inside Show, which was a show that started on YouTube that's now a Netflix exclusive. What was it? Amazon Prime Video paid Mr. Beast to make Beast Games. That was also like one of the most popular TV shows that they've ever put out, and they're looking at season 2 and season 3 as well. So I don't know. I just think YouTube is king. Not KSI, the Sidemen. All right. Well, I don't follow KSI's content all that much, but my understanding is he is like 90% of the Sidemen, is he not? There's like 7 or 8 of them, but he's by far the biggest. So I apologize to the other folk, but like I couldn't even name them if I tried. I probably could. You know what? I probably could. I follow a lot of YouTube's content. I really do like YouTube more than any of the other platforms. Um okay. Okay, let's see. Um let's have a look at X really quick. See if there's any JRE stuff that's already coming out. If there's any quotes from there, because maybe we can watch some clips. But yeah, I don't think we'll be able to watch the actual videos or like the whole 2+ hour thing. Okay, time to lock in. Stock culture is going mainstream, people are saying, because it's going on. I don't think it's stock culture. It's the most popular stock, but it's also the most important company in the world. I wouldn't call that stock culture. Okay, let's go ahead and check up on CNBC, see what else is going on. There were a couple other stories. AV Ride from Nebius, their autonomous vehicle program, is now testing in certain cities. I think it was, which one was it? In Dallas, in a partnership with Uber. Okay. So they are doing a partnership with Uber. Uber also came out and said that they think that they are going to have fully autonomous self-driving vehicles in more than 10 cities by the end of 2026. Which, to be honest, now that I'm reading, at the end of 2026, doesn't sound that fast. I hope that it, like, we hit this sort of breaking point where it's so common that it just is in every major city over, sort of a year time. Maybe I'm too excitable. I could definitely be true. Okay. We need to check the Fed watch really quick. The chance of a rate cut must have spiked after today's jobs report. 89%. Okay. Yeah, it's coming in pretty high. 11% chance that we have no change on rates, 89% chance of a cut. Waymo is Waymo ahead of the relative to that. I like Uber, but they need to drive partners. Yeah, but Waymo is a Uber partner. they're using Uber in cities. I don't remember which ones. I think Austin. And I think that was their best performing city out of any of them. And that was in partnership with Uber. So it is important to keep in mind. OpenAI is buying Neptune, a Poland-based startup whose tools it already uses to track and debug AI training runs in an all-stock deal per Bloomberg. In an all-stock deal. Neptune has about 60 employees and will wind down external customers like Samsung and HP as its platform becomes an internal tooling for OpenAI. That's beautiful. They've been acquiring a lot of these small startups. In the next breath, however, there was also a report that came out. Wall Street Engine ended up posting about this, but he has the original article here as well. OpenAI chief researcher Mark Chen says that AI talent war has gotten so intense that Meta tried to poach half of his direct reports, and Mark Zuckerberg even hand-delivered homemade soup to one of OpenAI's engineers as a recruiting pitch after earlier dangling $100 million offers. I mean, we can't keep giving $100 million, so I made some chicken noodle. If he brought me butternut squash soup, Mark, I'd come work for you, baby. It depends on the soup. You get it wrong, I'm sticking with OpenAI. But half of his direct reports. If Mark was smart enough, he would have done what Microsoft did and just bought half the company a long time ago. But now it's not out of their reach, but okay, I'm starting to see clips now of Jensen Huang. Let's have a look at this really quick. I don't know if I get pulled down, I apologize.
When I announced this thing, nobody in the world wanted it. I had no purchase orders, not one. Nobody wanted to buy it. Nobody wanted to be part of it, except for Elon. He was at the event, and we were doing a fireside chat about the future of self-driving cars. And he goes, you know what? I have a company that could really use this. And I said, wow, my first customer. And so I was pretty excited about it. And he goes, yeah, we have this company. It's a nonprofit company. And all the blood drained out of my face. I just spent a few $1 billion building this thing. It cost $300,000. And, you know, the chances of a nonprofit being able to pay for this thing is approximately zero. And he goes, you know, it's an AI company, and it's a nonprofit, and we could really use one of these supercomputers. And so I picked it up. I built the first one for ourselves. We're using it inside the company. I boxed one up. I drove it up to San Francisco, and I delivered it to Elon in 2016. And I walk up to the second floor where they were all kind of in a room, this smaller than your place here, and that place turned out to have been OpenAI.
It's not really nonprofit anymore, though, is it?
They're not nonprofit anymore. Yeah.
Weird how that works.
There is a nonprofit arm still, but yeah, I mean, the high majority is definitely for profit. They're enjoying the profit. Well, if you consider profit after cost of goods and then after operating, I mean, there might be gross profit. I wonder if they even are gross profit margin or positive. Do you think they have gross profit? Net profit, definitely not. They're definitely at a net loss after sales and marketing and technology and development expenses and all of those things. But I wonder if the cost of goods, just the total token expenses that they have to pay for their customer queries that are giving them $20 a month, that part is probably profitable. But yeah, they're definitely not net profit positive. Gemini 3 is awesome. Um, dude, I, you can say whatever you want. You don't have to say allegedly in Minecraft or whatever. That's so funny. Not the allegations, but the trying to be appropriate and saying what you really want to say in those comments. I'm not going to read it out loud just in case, but okay. Did you guys know that the one of the Truist analysts ended up speaking on which companies they believe could enter the S&P 500 next, and they put 3 fintech names: SoFi, Affirm, and Toast. Okay, and let's take a look here. Several fintechs, including Block, which they have a hold on in their coverage group, as well as a handful of capital market firms, were added to the S&P 500 in 2025. But we believe it's possible that SoFi, which they have a hood on, a hold on, Affirm, which they have a buy, and Toast, which they have a buy, could be added to the index in the near future. There's a fair amount of uncertainty here, as the investment community at S&P 500 Dow Jones has discretion regarding which stocks will be added in the index with each quarterly rebalancing. That said, we believe investors should take into consideration this potential positive catalyst, as Affirm and SoFi meet all the requirements, while Toast is marginally below the market cap threshold. However, Affirm and SoFi, out of those two, we'll see. We will see. We already knew that, but now you're starting to get some of the Wall Street guys also talking about the potential for them to be added into the index. Another thing that I wanted to touch on, by the way, we were talking about Waymo. Can I actually talk on this really quick? DoorDash in Waymo starting. Just going to open up your trunk. You have to walk out of your house going and getting it. The only way that I think that this is viable is if it lowers the cost of, maybe you don't have to tip a Waymo or something. Maybe the total cost of delivery is slightly lower. But in order for someone to walk out to their house and go out onto the street or whatever, pop the trunk, and then you get your food, we'll have to see. And does it pop for anyone? Like, maybe there's going to be these little food theft videos that happen online. Freudian slip, yeah. SoFi, hood. Okay. I like it to my door. I do too. It's snowing here. Like, if I'm getting food delivered, I don't have shoes on, I'm all comfy. I'm not going out into the snow for a Waymo to pop its hood and then me grab food. Put it right in my doorstep. Your phone gets a code. Love it. That makes more sense. I have to walk out of my house. Too inconvenient. You guys don't have bad weather. Clearly where you are, there's no bad weather. For me to walk out of my house right now, I got to put on like snow boots and a winter coat. It's not that bad right now, but it does make a big difference than opening my door and just leaning out and just picking up food. That is a difference. California. Yeah. I'm in Ottawa. I feel your pain. Yeah, 100%. You get it. Negative 32 here with wind chill. All right, you beat me. That's insanity. All right, okay. A lot of you guys have it worse than me. All right. You know what? You're right. I'll just go get my food from the Waymo. Nubank. Obviously, we did see this stock end up pushing a little bit higher, now meaningfully into the $17 ranges, and hopefully we push into 18s and 19s soon. But there was a nice little report, not only, which is actually probably bigger news, they're going to go for their full Brazilian banking license. going against the Itaús of the world and try to, maybe allow for them to get into mortgages and all these different things. But, that's only if they actually need to, if they're having troubles growing into the much higher return on equity products that, they can see from some of their unsecured lending products. But then we also saw this report. New Colombia reaches 4 million customers, doubling its base in 1 year. Part of that doubling was actually an expansion from just sheer credit cards, okay, to now allowing for what do you call it? Bank accounts, personal loans, all of these different things, debit cards. Those really allow for much larger customer reach. However, reaching 4 million customers in a country in just 4 years shows that people were ready to adopt a different financial offer. 4 million people have placed their trust in Nu, which fills us with pride, and many of them have obtained a credit card or invested in a CDT for their very first time. We'll continue to focus on offering unique, frictionless products and experiences and working relentlessly to be the most influential and beloved financial institution in the country. Colombia is where David Velez originally comes from. So that was like one of his most excitable sort of entries that he wanted to do. Although it was a much smaller offering, like the total addressable market of Colombia for Nubank is much smaller than Mexico and Brazil. But, maybe it touches home for the CEO, so they had to go there. The next one is probably going to be Argentina, and then the next one after that, the United States. We already know that they want to get into the United States full banking charter with the United States, but that doesn't necessarily mean that they need to offer customer accounts. They probably will, but fully aware that Jensen's on the JRE, by the way. We've shown clips where we are following it, but I can't watch it live right now. Yeah. That said, Nubank, very excited for. They continue to do well. Someone also asked in the chat earlier, make yourself known if you're here. Also, Express Investing. Paul, you need to change your name, and then let me make you a mod as well. I'm sad that you lost your old account, brother. That's a shame, but let me... Paul deserves to be modded. All right. Someone in the comment section before was talking about when will SoFi introduce prediction markets, and a lot of people have had some concerns about that. Me, not so much. However, we're starting to see this larger and larger adoption. CNN will now integrate Kalshi's prediction markets across its news coverage, bringing real-time event forecasting to its broadcasts. Do you think CNN or Fox or something like this is bringing real-time DraftKings or FanDuel, odds onto their news things? No. I think that this was the first of very many more partnerships that is going to not popularize, prediction markets, but legitimize them. Okay. There are customers that Kalshi has been highlighting of these people who have very, very high win rates. Okay. A gamble, yes. Is it investing? Are you buying assets? Do those assets have voting share into the future of those businesses? No. Okay. Like, I'm not trying to compare this to investing, but is it the same as pulling a one-armed bandit and trying to go for 3 sevens? Not even remotely close. The odds are, well, essentially as well as the industry. If you're in sports, there might be an advantage if you know players' injury rates, scoring, the team differences, the past history of who has done better the last time that they've seen them played at home, played in a away game. All of these different things could affect the scores. Okay. For the people who are really nitty gritty into that system, there's alpha there. There's an advantage. Okay. One of my advantages, for example, in prediction markets was whenever they said, hey, will SoFi beat or miss on EPS? And there was a 70% chance that they said that they were going to beat. I don't have access to these tools yet. Canada is not adopting them, really. Maybe there's one, but I have not seen it. But for me, like a 70% chance that SoFi was going to beat their earnings last quarter, in my head, it was 100% chance, or at least a 99.999% chance. I sounded like angry Hitler there for a second. I'm not trying to, but a very high percent chance. That was a German no reference from, what was it? What movie is that? The Quentin Tarantino movie. The mustache isn't helping. This is a full mustache. Do you want to trim the edges? No, thank you. I'll keep it. Inglorious Bastards. Thank you. Tanner, should we take my company public? Please advise. I don't know your company, but I like whenever more companies are public than not. There you go. BMNR ex-dividend date is this Friday, December 5th. Oh, get ready to see your 1 cent annual dividend. That's exciting. Okay. Let's also take a look at BMNR up 4%, $33 on BMNR. Look at just like the crazy pricing in this small amount of time. 32 to 34, 37, back down, back up, back down. It's insane volatility. Yeah, are you gonna drip that dividend back into BMNR? Who's dripping their BMNR dividend? Let's see. What is the ETH? What is the ETH even tonight? The update? Dude, I've tried explaining Fusaka. I don't know. You got to talk to a developer, man. I'm not really... people tell me it's bullish, and then I go, okay, it's bullish. I'm not a coder. I'm not a developer. It's a lot of the background upgrades that are exciting. Okay. I'm treating myself to nice holidays with that dividend. I mean, you got a lot of BMNR then. Who's getting ready to buy those penny sweets? Put the dividend into a SoFi savings account. Turn those couple pennies into a couple pennies in a few decades. All right. That said, what else did I want to cover? The Anthropic going public deal is pretty interesting. There were a lot of talk about Anthropic going public as soon as 2026. Anthropic came out. They said they're not going public. Then other people said that's what you were going to say, but you are. We know. But it would still be one of the largest IPOs in history if they did do that, valuing them at over $300 billion plus. And if they wait, it's only going to break more records, as I think that the valuations of those companies is going to go up, not go down, as some people suggest. Okay. Let's have a look at CNBC, see what some people are saying. Okay, this is good. This is good. What are going to be some major new themes in 2026? Then remember, as the title suggests, we are listening to 3 different fireside chats on this call. I completely understand if you guys don't want to listen along to that. That's perfectly fine, but I'm going to have to listen to them. And I used to just end the live streams before I just listened to them, but I know that a lot of you guys still want to hear them. So we'll do it together. At 2:15, we have Shift4's Fireside Chat. Okay? At 2:55 p.m. Eastern Standard Time today, Chime's Fireside Chat. This one, I'm honestly, guys, I think that they can say some very exciting things here about new product developments, what they're doing with Chime Core. I honestly think out of any of them, which one is it going to pop on earnings or on this Fireside Chat? It's going to be Chime. Okay? Or go down. That's actually, I was going to show off this thing here, but actually what I should show you guys is the Fireside Chats do have an impact on the stock price. Let's take a look at where the heck is the Y on my keyboard? PayPal. Look at these huge red lines. What do you think happened this morning? They had a Fireside Chat. And they also, during that Fireside Chat, were talking about guidance. They also said that that guidance is not going to be good because of macro events and because of bad comps. The market did not like that. Okay? So there could be bad news that we end up seeing from these Fireside Chats as well. Okay? So Shift4 at 2:15, Chime at 2:55, SoFi at 3:35 p.m. Eastern Standard Time. Let's go ahead and watch what potentially the major themes of 2026 are, according to someone at CNBC here. Jeff Kilberg, the KKM Financials founder. That's who. Okay, I'm sorry. No sound? Okay. Okay, that's why you guys didn't hear any of my jokes. Because I didn't know what his name was, and I was hearing her say it live. But yeah.
Kelly, on behalf of the middle of the country, it's great to see you back. Welcome back.
Thank you. Do you want to pick up on anything you just heard before we dive into the Bitcoin layer here?
Well, I think it's interesting talking more about international, but I think international has played a part in a portfolio, but I really see the broadening of the S&P 500 equity market outside of the Mag 7, the rotation inside Mag 7. I think that's going to be the more of the major theme going forward as we see interest rates move down. So I'm optimistic on equities. I think we see the Santa Claus rally here in the month of December. So I am optimistic, but I think there's going to be more broadening. It's not going to be the usual suspects per usual.
Okay, so is that why you're worried about Bitcoin possibly taking another leg lower here? And again, you're someone who owns it and I think is long-term bullish. If correct me if I'm wrong.
Correct.
Describe what you think is going on here.
I think saying equities and crypto in the same sentence is not 2025, nor it's going to be 2026. We saw decoupling. That lack of correlation happened back in April when we saw the NASDAQ 100 and crypto, specifically Bitcoin, really decouple from each other. So I am cautiously optimistic, but I didn't like the fact that we didn't see this pullback, which is completely healthy. Let's remember, Kelly, I go back to 2017. That's when the CME group started trading Bitcoin futures. So if you look from 2017 until now, there's been about 20 different pullbacks of 25% or more. We just endured a 30% pullback. We've actually seen 3 pullbacks of 50% or more since the futures started trading. So I don't think this is unusual. The acute volatility is sensational, but I think the fact that we didn't go back and fill down to that April low of 76,000, that's where I think the market wants to go. But at the end of the day, Kelly, there's so many new organic buyers. Look what Vanguard just did. They opened up the faucet to many more buyers. JP Morgan, there's a lot of new players and products in the accessibility. Look at IBIT. IBIT has had $32 billion of inflows just in this year. So these new buyers, it's very different than the stock market. If you think about it, Kelly, on a stock, there's a sell analyst, there's a buyer analyst, there's always different ratings. Not really in crypto. If you don't like crypto, you just don't participate. So it's a kind of a different animal.
Yeah, I saw Larry Fink saying today that, the more he traveled the country and talked to people, the more he saw the use case for crypto. I would say I understand the use case outside of the US, but I almost feel like the more that I talk to people, the less convicted I am that Bitcoin should have any fundamental price value. It's kind of just a community thing. You're like you described.
And that's the head scratcher. So when you saw it up at 125,000, you were getting an Uber rides and you were talking about buying crypto. So that is that kind of moment in time. And now the people who just bought there and seen a 30% drawdown, are they going to take that tax loss harvest before the end of the year? Are they going to have the appetite moving forward? But I do know a lot of the advisors I support, they're trying to really understand what is that crypto exposure, not just necessarily Bitcoin, but what is that crypto exposure moving forward? Is it 1%, 2%? It's kind of like when people are dipping their toes into commodities. Look at gold and silver. Obviously, completely different.
I was just going to ask you. Just going to ask.
That's the more tangible component, and that's where we talk to a lot of our folks. We've owned gold, we've owned silver. It's been very tactical, but this is a conversation which is very different than Bitcoin, which I know is the new modern day version of gold.
Well, to those who like it, I guess the final then for 2026, it sounds like you're saying, Santa Claus rally, market broadening doesn't necessarily mean crypto participates. What's the rest of the narrative for you? The sort of the 30,000 foot story.
I think the 30,000 foot story is that interest rates are coming down. Immaterial, yes. I'm actually going to be out visiting with you on set next week for Fed Day. So yes, we are anticipating the Fed to have 25 bips. But moving forward, rates are coming down. If you look at the 2-year note, that's kind of the precursor, the predicting component of where the Feds should be. And I think the overarching theme of interest rates coming down, that's going to be supportive of equities. We haven't seen the 10-year really spend much time under 4%. So if we get down to 3.5%, Kelly, that's going to incentivize, it's going to help home buyers. I think it helps a lot of the laggards in the market. I think it helps the financial. I think it helps all the sectors that we've been talking about that have been dispersed from obviously technology and utilities. That's where we see it. But it's interest rates, interest rates, interest rates.
I mean, one interesting thing, in my opinion, is like if we do end up seeing interest rate cuts, which I think we will this December 10th, it's like financials and artificial intelligence for me seem to be where I'm suited best. One, you get such an advantage from interest rate cuts for names like SoFi. So some of the financials will win there. And then on the AI names, they're honestly so big that regardless of the decision, like NVIDIA doesn't need any rate cuts to continue growing. So to help fulfill the rest of the world's problems, that like the economic problems, rate cuts are going to come down because they only have one broad tool. There's no precision that the Fed has. It's like a big blanket cut rates or don't cut rates, right? Or hike rates. But the industries that are doing well, essentially, you're just going to be putting jet fuel on them because they're already doing well. And now you're going to lower interest rates as well, which is only going to speed up the AI progression, allow Oracle to take out more debt, some of these companies to start making, bigger and bigger bets because the cost of capital goes down. We'll see. We're skyrocketing right now. Let's take a look at Bitcoin. Why did you do this to me? 92,000 is not bad, but I was expecting green candles. ETH 3,100, 3,100. Tesla up nearly 4%. UiPath 4% going into earnings today. That could also be quite exciting. Rocket Lab up 4%, $43 a share. UNH up 4.5%. Carvana up 4.6%. Robinhood up 4.8%. Yes. Yeah, Ben. Yeah. Johnny gets it. Poets up 20%. I don't think I follow them. 22% on Poet. Was this, let's check. Was this earnings related? Probably earnings related, yeah. I'm getting tons of Tom Brady Shark Ninja ads on IG. Nice. Okay. Tanner, if you'd have to choose just One for 6 to 12 month period. What would it be? Shift4 or Chime? Ooh, I've already decided Chime. Shift4, like, I don't know when the sentiment is going to turn around, but I think fintech is going to be very loved. And I think all the comments recently, like what Scott Bessent said, massive tax refunds, like the new products that they're going to enter. I'm very excited for Chime over the next even just 6 months. So that's quite cool. That's how the rich can take over. Drop the interest rates to nothing and let inflation skyrocket. Yeah. All right. Where's SoFi? Oh. Turning negative. What else is down? Broadcom, Autodesk. I just saw Amazon. Where was Amazon? Just saw them a second ago. Microsoft, Alibaba, Bloom Energy, PayPal, Lithium America, Micron, Spotify, but also the VIX is also down. What an interesting market this is. Man, I love stock markets so much. It's so much fun, isn't it? Poet is the solution to the lack of energy on data center space. Yeah. That is definitely going to be an interesting area for sure. For me, I was been more looking at Bloom Energy, but honestly, sometimes you have to bet on culture, in my opinion, and a company whose founders are okay with paying influencers to pump the stock and not the actual product. I don't only think is like bad practice. I literally think it should be illegal. I have no belief in those people. I think that those are bad, like terribly bad reputational decisions. And so I don't care how good the business is. I'll never invest in that business. That's just my own personal preference. Maybe you guys like whenever influencers are paid by companies. Yeah, that's why I'm saying I'm not investing in Poet. Just bought some more Weeble. I think that'll be good. I think the brokerage space is very interesting. The U.S. Census Bureau had me complete a mandatory business trends and outlook survey today for my brewery. Most of the survey was about AI impacts on your brewery. Nice. That's an interesting thing. Yeah, AI beer. I guess there would still be AI. Like, that's the thing about AI. It's like it doesn't have to affect the product, but it could potentially help with the sales of it, I guess. Help understand who your customers are. That sort of trend. I don't know too much about the brewery space. It is, how does the sort of breakdown between wholesale and, like, do they do any direct to consumer? I guess there's certain breweries that do. But legitimately, I don't even drink, so I know nothing about the brewery space. Okay, this is another thing from Robinhood. Remember, in 9 minutes, we're going to have Shift4's fireside chat. So I got to make sure to get that up and going. But this yes, no prediction markets thing, I am so excited for. Like, whether if you guys have a moral qualm, or you have known people that have been, very strongly impacted in some sort of gambling thing, and that's why we have strong convictions, yes or no, on certain products, I completely get that. For me, unfortunately, or maybe fortunately for me, I don't have really bad incidences with people in my immediate circle with gambling. So maybe I just haven't felt the impacts myself. But so I'm just looking at this from a pure business standpoint, and that might be the wrong way to look at it. So you're going to have to judge that yourself. But prediction markets is growing so unbelievably fast. The take rate is changing in real time as new entrants are coming into the space. There's so much like institutional opportunity. There's huge. I mean, like, talk about a product that I honestly think could 100x or even 1000x from here. It's nascent right now, and there's certain companies that you could buy that are, massive percentages of the market share. That does excite me from a non-moral standpoint. I would just look into it if you guys are interested in sort of some of these industries that have small but very fast-growing total addressable markets. I covered this actually recently on one of my recent course videos, and it's not just about finding, like, whenever you're looking into smaller cap companies, it's not about finding a small company in a big TAM. The way to really find businesses, historically speaking, is find companies in small TAMs that are really fast growing. Okay. Then those companies grow along with them. And OpenAI is probably the biggest example of that. It's not that AI was the big TAM. It was extremely small, and they were the biggest player in it. And that TAM expanded, which blew up OpenAI as well. But yeah. I don't even do options or anything really that has an expiry. So I'm a big believer in, buying the actual assets and having ownership in the companies that I like, and I hold them for long periods of time. So that excites me. Let's go ahead and get the Shift4, the Shift4 Fireside Chat webinar ready. If I had to pick a company to do all these fireside chats, I mean, UBS is all right. I just wish there were videos. Okay. I should also send out a tweet so you guys all remember that 215 Shift4, 255 Chime, 335 SoFi. Those are all of them. Is right now a good time to DCA into VOO? Does it matter what day we DCA? So what I would say is that if you're DCAing, you probably shouldn't try to time your DCA into VOO. The idea is there's not a good day, there's not a good time. Time in the market is better than timing the market. VOO is perfectly fine. Like you can definitely VOO, VTI, something like that. A spread mix of both, something like that is like extremely diversified. DCAing is really smart, but if you're thinking about timing, you're already doing it wrong. Every day is a good day to buy VOO. Okay. So far, I haven't convinced AI to help me. That's funny. Hey, Tanner, did you catch Stock Talk this morning on Amit's channel? Any names stick out to you? Just nebulous, really. I did listen to it, but I've been following Stock Talk for a little bit, so a lot of those names he already talks about on his X. Okay. Let's see. Any other news today? Before we get into the Shift4 conference, we have about 4 minutes. Yep, Salesforce earnings are today. I'll be talking with Steve at about 9 p.m. Eastern Standard Time. I'm pretty excited, to be honest. ETH might rip right now. I think it could definitely happen. I am a believer in the sort of end of year rally. I don't think it'll go to 8,000, but do I think that we could see 4,000 by end of year? Like, yeah, it's definitely possible. I have VG on the watch list, but I don't follow the company. Don't sound excited for Salesforce? No, I'm excited. I like Salesforce. I especially like their valuation here. Tanner, would you drop your Grok subscription and try GPT paid? Yes, 100%. That's like literally my plan. Tanner, I just bought into my first Canadian company, Kraken Robotics. Trades in the TSXV and Pink Sheets. Profitable and growing quite quickly. Good proxy to Anduril. A lot of drone names. I'm not... I haven't participated, really. I don't know Microsoft well enough to know a good entry price. I haven't been following too much. And honestly, like the reports that came out today about the whole Copilot thing, yeah, I don't have faith in Copilot. Like, I don't believe in it. So if I were an investor, I'd be there for Azure or Microsoft Office and these sort of products. But I probably would agree that their cross-sell to a Copilot is probably worse than other crypto names. I have crypto in my SoFi account. Got it Tuesday. B-dubs. That's super exciting. That is super exciting. Are you buying anything in it, though? But you own Joby? No, I don't. I mean, I might have it through the community fund, but I don't... No offense, I don't care about Joby at all. I'm not saying that it couldn't work, but I'm not willing to take those early bets on a name like that. Oh yeah, I have all those names in my drone portfolio, or my drone. It might as well be a drone portfolio, my community portfolio. Yes, yeah, you're right. Is 29 good entry for SoFi? I mean, there's so many things to consider. What your timeline is, like, it's hard for me to give a blanket statement. Yes or no, is it a good buy? B-dubs is considering buying ETH. But you don't want to touch BMNR, eh? That's all right. Trump is meeting with Jensen to discuss export controls. Don't disparage my Joby. Dude, if I could pick between Joby or Archer, I would pick Joby. But right now, until these companies make any profit, I think they've run a lot. Like, I don't know. American Airlines. American Airlines is a $9.6 billion company. Joby is a $13 billion company. I mean, like, what are we talking about, dude? The upside is already taken care of. What's another Delta? Okay, maybe I just picked a really small airline. I didn't realize American Airlines was so small. Delta, 44 billion. What's another UAL? United, 35. What's another airline? But like, they're bigger. The TAM is huge, though. The TAM is non-existent. There's zero TAM. There's not a single person making any money taking these electric vehicle takeoff and landing things. The hope is high, but you're paying $13 billion for hope. Okay, Shift4.
In Shift4, we've known Chris for many years now through various industry events, our Napa conference, ETA, and some industry events. So we were just really happy to see Chris named to the CFO position, and we're really pleased to have him here with us on stage. Thank you, Chris.
Thank you, Tim. Thanks everyone at UBS for having us. Really excited to be here.
All right, and also a special thanks to Tom McCrohan. Tom, head of IR for Shift4, works very closely with our team and also made the trip out here to Arizona. So again, we appreciate you both making time in your busy schedules to travel out here to be a part of our conference many years in a row now. So thank you to Shift4. All right, well, we've got a great list of topics to get through, and we're going to start off just addressing some of the recent macro that's been called out by the Shift4 team. Chris and Taylor and team talked about a little bit of volatility, right? Some weeks up, some weeks down, and Chris was just put a little bit of context around that and maybe talk a little bit about how investors should be thinking about some of the Q4 guidance metrics.
Sure. I think what you're alluding to is on our third quarter earnings call, we made reference to a couple of data points that we were seeing within our really broad data set. So as a scaled payments company that has really great vertical leadership within areas like restaurant and hotel, we have the privileged position of seeing a lot of interesting data. And something that was coming in as a question was what were the recent trends around that data? And one of those trends was that, in the domestic restaurant, domestic lodging categories, we were seeing kind of week rolling 7-day year over year trends that were, call it +1% to -4%. For context, we're used to seeing those trends at the, call it ±1% to 2%. So a narrower band is what we're used to seeing, and the range was slightly more downside biased. And we wanted to call that out because it has had an impact on the same store variable within those verticals in the base. At the same time, we're really proud of the fact that from a vertical diversification standpoint, we are seeing the leadership position we have in stadiums entertainment, the leadership position we have now in luxury retail, and in other verticals more broadly. It gives us a vantage point that allows us to see not only those trends, but trends as a whole that I think are quite interesting in our business and certainly have been interesting to investors. Topic of a lot of conversation.
All right, great. Well, thank you. It's a great way to recap. Maybe you could talk a little bit about now, so we're a little deeper into the quarter and really what that means around that range that was provided for Q4 GMV.
Yeah. So let's start with the trends. I mean, they remain consistent in terms of what we had previously discussed and disclosed. And from that standpoint, we remain with, a more cautious tone within it. But as it relates to the guidance itself, what we had talked about, really no change in sort of our thinking around it, consistent with the way we had felt in the quarter.
All right, sounds great. Thank you, Chris. Let's move on to the Shift4 way. So this past year, we've seen Shift4 do more of the type of activity that would very much be aligned with the Shift4 way. So you've been making some acquisitions and really executing on some of the prior ones. Vectron, VenueNext, Revel, Appetize, and many more add to that list, which we like to say is they add to your cross-sell Rolodex. And Global Blue, Bambora, SmartPay, the list just continues to go on. Maybe you could talk a little bit about some of these specifically and how this will feed into kind of next year's cross-sell funnel.
Absolutely. Well, actually, it's where you ended that question is exactly the most exciting part about the acquisitions that we make, because from our perspective, topping the funnel or adding to this cross-sell potential that we have is one of the most attractive parts in what we believe is, our unique model. The ability to deploy capital in order to obtain a unique and differentiated access to customer acquisition and expanding our markets is, I think, one of the most important things that, that we do in order to differentiate ourselves and drive a better return of capital outcome right at the unit economic level of customer acquisition. We could deploy capital in a lot of different distribution channels, distribution methods. You could put money into a Google AdWords campaign. For us, this idea of being disciplined on the acquisition of a business that has an installed base and a state, a cross-sell potential in its funnel that we can then, through that acquisition, have differentiated and low and disciplined cost of capital to really convert and acquire the customer. To us, it's really quite a distinction in our unit economic model, and one that historically has driven high returns on capital over time. Bucket one, that's why in our kind of strategic priorities around acquisition capital allocation, we talk about the cross-sell funnel as like one of the most important priorities. The second priority within it, though, that comes is often capabilities enhancements. So even though most of these acquisition theses are justifiable on their own from the perspective of the funnel, they often come with interesting capabilities enhancements. What is a capabilities enhancement? In the case of Bambora, as we announced in the third quarter, the bringing on of a payment modality like EFT ACH in North America, that's a competency, a capability that we didn't have before. In the case of Global Blue, we often talk about the tax-free shopping, the entry into the luxury retail category. What we don't talk a lot about is that they brought a proprietary dynamic currency conversion capability. That DCC capability is not only an interesting product in and of itself, but it's something we can cross-sell back into our base. So this idea that capabilities come over and above these incredibly interesting cross-sell funnel opportunities to expand that is something that is an important part of what we underwrite within our models. And then the third from that is simply market expansion. So the opportunity to expand into a geographic region or densify a geographic region. We announced the closing of SmartPay in the Australia-New Zealand region. That created a lot of density for us in a country that we were emerging and growing our share within. In the case of Bambora, that's giving us more North America, which really is about, in Canada, building some density there as well. So 3 big buckets, the idea of expanding funnel, the idea of capabilities enhancements, and the idea of market expansion. Those are all the ways with which we think about excitement within these underwritten acquisitions.
Excellent. Thank you, Chris. A minor follow-up before we get into some of the vertical mix, but related to that cross-sell funnel, shifting over to end-to-end volume, would you say that there's any change maybe in the composition of that as we head into next year, as we think about kind of higher yielding merchants versus lower yielding in terms of their merchant size?
Yeah, no, it's a great question. And it's an astute observation. Our business is one, when you go to the history of the company, we were really a business that was born SMB. In the history of the business, really born one vertical, where our first vertical of real strength and leadership was restaurant. We were born SMB there. And then for those of us that have followed the story over the years, we went from one vertical market leader to becoming now a vertical market leader in 4 verticals. Restaurant, we had hospitality, you had stadiums and entertainment, and now luxury retail. The interesting thing within that mix is verticals 2 and 3 are good examples of places where our mix started to shift towards enterprise. So over the last few years, you would have heard the story in our narrative, and you would have seen it in the numbers, that our volumes were growing faster than our spreads. And that was because of this mix shift towards enterprise. But now you can fast forward to Global Blue as a good example of an area where our most exciting opportunity within that business to cross-sell is within the SMB. It's not, contrary to popular belief, it's not necessarily in the enterprise side. It's actually about the opportunity in SMB. To contextualize it, there's a $500 billion sort of cross-sell funnel type opportunity within for payments within Global Blue. $100 billion of it is the SMB component. And so when you think about, well, what does that mean over time within the narrative? Well, if you follow the history, born SMB, single vertical, adding leadership in verticals that tend to be enterprise, mix shifting towards enterprise, there's a scenario here, not trying to do any sort of guides around this or anything, but there is a scenario here where we may see mix shift that is different than this historical trajectory.
Excellent. That's really helpful context. Thank you, Chris. All right, so I think you hit a little bit on the SMB versus the enterprise evolution over the years and how that could look a little bit for next year. Maybe we just touch on that point of yields. Maybe we can do that more from a vertical view and also a US versus international. Just any high-level comments you could make around directional take rates. I mean, obviously we know restaurants a little higher, hotel a little bit lower, and then maybe you could expand upon that across the other verticals.
Yeah, the take rate to volume question is something that if you're a student of the payment space, and I've been investing in the payment space or around the payment space for almost 2 decades now, like there's this very popular chart that's always shown to you when you first start studying payments. It's 3 pyramids that show you that volume is really a cascade. Like you have this inverted pyramid that shows you that volume, the most amount of the payment volume sits with enterprise, the least amount sits with SMB. But then right beside it is an inverted pyramid that shows you from a revenue standpoint, AKA translating that into spread, the revenues and the spreads are the smallest in enterprise, and then they're the largest within SMB. And that dynamic is really something that I think is important to understand, because when you start to think about verticals, what we see is that a vertical like stadiums entertainment, a vertical like lodging even, they tend to be more enterprise skewed. And then within our base of unified commerce, you have very, very large enterprises that, that run everything from technology and telecom to public sector and a nonprofit and a variety of other areas. And so depending on that mix of the business from a vertical standpoint, you actually can triangulate a little bit to an enterprise versus SMB mix. In restaurant, more SMB, and in what could be luxury retail, probably to be more SMB.
Thank you, Chris. And on US versus international, we understand there's a little obvious changes on the gross level, but when we get down to the net take rate level.
Yeah, so it's interesting because I think there's a prevailing view that take rates in international markets relative to the US are lower. And actually what we've uncovered is when you're bringing a value proposition of bundled integrated payments, software mixed with the proposition that we bring of software, service support, hardware mixed with the bundled payment offering, that whole collection together is delivering value that actually is translating into a monetization of spread that isn't that dissimilar to what we're seeing in the US. And that I think is yet another surprise that no matter where you are, solving complex payment problems through an integrated solution and delivering this, call it one hand to shake kind of an approach, it really does have monetization power.
All right, Chris, that's really helpful. Thank you. All right, we're going to move on to SkyTab. So SkyTab clearly well covered at the Investor Day, but let's do just a little bit of a kind of a recap and refresh on SkyTab. Just starting with a little bit of what's the ideal or average restaurant size, or what's the real target market for SkyTab? And then more specifically in terms of the competitors, I mean, how much is it up against a Toast, Clover, Spot On, Micros, NCR? Who are the most predominantly viewed competitors that you go up to against head-to-head?
Yeah, I think we often talk about, with a healthy respect, Toast as within the restaurant space. I don't think that should surprise anyone that we sort of view them as the market leader. At the same time, I'd be remiss if we didn't mention that, seeing Micros, aka Oracle, in a lot of hospitality in restaurants that are tied to hospitality environments or enterprise restaurants themselves, that's fairly common too. Don't know where your dining patterns are, but if you took a look behind, behind the wait station or the bar, you probably see those systems as being pretty prevalent. And that's really where I would say we see our offerings play, and where and you could define the category that way. It's really about table side dining, and it's really about the caliber of restaurant that you would see a Toast or a Micros in. Now, I think there are some unique differences though as well, which is to say each of those parties has their own subcategories. I think it's too easy to paint with a broad brush that restaurants are restaurants. The reality is table service restaurants, table service dining, and the complexity of what a POS does in table service is very distinct and different from what it does in QSR. And when you think about a Toast, for example, you might see them straddle that world of table side and QSR. In a world of Square, you don't see Square in table side, but you might see them more in something that is a mix of restaurant to retail, right? You might see that category. So it is important to understand, I think, those distinctions when you're doing your market mapping of competition, because not all of those categories are ubiquitously served by a single POS.
Excellent. Thank you, Chris. A minor follow-up to that. So clearly when you're selling a modern point of sale with a software component to it, along with end-to-end payments volume, there is a total cost which can be split across either SaaS fees or payments revenue. It's kind of your choice on how you want to do that. Clearly, Shift4 has gone a little bit more towards the payments means of monetization. But when you're pitching to a restaurant and you're talking about the total cost that they're going to pay, how would you compare the SkyTab offering to some of those major competitors that you just mentioned?
Yeah, I think we undoubtedly believe that we have lowest total cost of ownership to a restaurant merchant. And it's important not just from an upfront standpoint. It's also about the over time, the idea that there isn't going to be a nickel and diming around peripherals, right? Our uptime is your uptime. Our North Star on the most important part of the revenue model is the transactional component of monetizing payments. If I take that out of the jargon for this room, it really means that if you're online, if you're uptime, if you're actually delivering revenue to yourself as a merchant, that's the only way we're also going to receive revenue. And so from that standpoint, I think we're very well aligned. So there isn't an upfront to buy multiple POS stations at $5,000 a pop. And then every time a peripheral changes or a handheld changes or this, that, or the other, there aren't charges for those things from that perspective. We're really about trying to align ourselves to the uptime and deliver the lowest total cost of ownership.
Excellent. All right, Chris, we're going to move on to another great topic, which is stadiums and events. So at the time of the IPO, there was the one stadium, there was the Raiders Stadium, and now there's a whole bunch. And every shareholder letter has a bunch more in it, and it seems like there's a press release every few weeks. Part of winning those, we know, has to do with some of the ability for Shift4 to process payments across, again, in that multi-software environment. One of those environments is the ticketing environment. The integrations that you've done with Ticketmaster, SeatGeek, Pacquiao, and TicketSocket, the list goes on. Talk a little bit about how that's helping you sell to the stadiums. Clearly, it's been working quite well. And maybe you could give us a brief update directionally on where you think your market share sits.
Yeah, it's a great nuance because you can look at the stadiums and entertainment environment. You can look at the logos that we talk about, and we often make mention of 3/4 of sports, professional sports venues are likely using our software. And this is really what we're talking about in the context of SkyTab Venue. And what does that really mean? That really means the in-venue experience around things like F&B and retail. What does it often not mean? It often does not mean the ticketing piece yet, which has been one of the fastest growing areas for us because even though we had the market-leading solution in SkyTab Venue, delivering the software that allowed for an integrated payment experience inside the venue, we did not, at the early phase, have the payment integrations for the aforementioned ticketing vendors. Building that integration library, so to speak, to the ticketing players was a piece in the deal objectives in the roadmap that we had to do. Well, we got that done, and once that did get done, you started to see a very nice attach rate coming through. As it relates to ticketing. An important component is on a relative volume basis. In some venues, ticketing relative to F&B volume, it can be 1-to-1, but in some venues, you can see a 6-to-1 relative volume differential in the ticketing side relative to what is transacted inside of the four walls of the venue. And so the ticketing opportunity is very exciting, and we are not at anywhere close to the same market share in ticketing as we are within the inside the venue experience of integrated payment and SkyTab Venue POS. So that's still a nice growth driver within that business. and something that we're obviously very excited about. It's also really important to note, just to underscore it though, that it's easy for us to say we are a leader within a vertical and that's the end of the story. I think this nuance that there are more opportunities because to get volume across different revenue centers, even once you've landed. So a lot of our verticals do still have land and expand potential even after the market share is determined.
All right, excellent. What we're going to do with the time remaining, we're going to hit a couple of financial topics, and then Chris was kind enough to say that he'd be happy to take a few questions from the audience. So if you'd like to, I'll bring the microphone around to you. Let's hit a couple of these quickly on a couple of financial items. So the stock repurchase program. So you talked about $1 billion repurchase program. I wonder if you could just expand upon that a little bit. What gave you the confidence, and kind of put that in context of some of your leverage levels, et cetera?
Yeah, I think for one, it's actually just been a recurring component of the business to evaluate, from a board standpoint, to evaluate the share repurchase authorization. If you look at the history of the company since public over the 5 years, we've gone from a no authorization to a $250 million authorization, doubling it to a $500 million authorization, and then the most recent announcement, which is a $1 billion authorization that'll go all the way through to the end of 26. In the ordinary course, the third quarter was the natural time for the board to evaluate the share reauthorization, since the prior one, or the most recent one, was supposed to expire at the end of the year. Now, it happened to coincide with things that seem to happen within our industry and within our own valuation that makes executing against that share repurchase authorization actually more of a priority than it may have otherwise been, which is to say, we view at present that the valuation underlying the shares seems like an attractive place to allocate capital, and something we talked about on the call for context. This valuation level for share repurchases would actually be below and lower than the lowest we've acquired shares in historical repurchase authorizations.
Excellent. Another $1 billion number, which is your guidance to reach that as exiting this guidance period in terms of your run rate for free cash flow. So right. You recently reiterated that. Maybe you could expand upon that target.
Yeah, I mean, it's one of those points of, I think I did get asked the question around at one point, if there was one KPI that mattered to you in terms of it getting to know you, what is it? And, at the end of the day, cash is king, right? Like adjusted free cash flow as a metric is an important North Star, and it's one that I think at the end of the day is what we should be measured on. The $1 billion adjusted free cash flow target as an exit rate to the 2027, the end of our medium-term guide, is what we've had as a target, and it is something that we are very focused on.
Excellent. All right. Well, actually, why don't we wrap with one last, and then we'll go to the audience. So the medium-term framework, right? So with the 3 scenarios that you laid out, maybe you could just talk a little bit about, now we're close to 1 year past, how you're tracking against those, what kind of confidence you have in the medium-term outlook.
Yeah. So no difference in the way we talked about this at the third quarter call. I mean, I think one of the things that we did talk about was within these 3 medium-term outlook cases, we have the case that we phrase as sit on our hands, which is a high teens case. We then have a case of sit on our hands or high teens, but then you add in the acquisition of Global Blue, which we announced at the time of the Investor Day. And then if we continue to deploy capital in a manner that's similar to what we've done in the past, we have this third case, which is a case that we feel strongly about because we actually have been able to announce things like Bambora, announce things like the closing of SmartPay, good places to have invested capital and places that we think will generate really attractive returns from. When you look at those 3 cases, I think from across the board, we view ourselves as having conviction around those cases. We even gave a kind of a pull forward of the medium-term guidance, a pull forward of an update to the medium-term guidance by disclosing an organic growth figure in the third quarter of year-over-year organic growth of 18%. That actually, in our minds, is a tracker method against the sit on our hands case, and we think it compares favorably. So, in summary, I think we feel good about where we're tracking on our medium-term outlook.
That's great, Chris. Thank you so much. And we did leave a few minutes in case anyone in the audience would like to ask a question. Please just raise your hand and I'll bring you the microphone. Here we go.
Thanks, Chris. A lot of your competitors are talking about making larger investments within direct sales force. Can you just remind us what your distribution philosophy is? And especially as you buy and acquire these assets, I'm sure they come with their own distribution. How do you synthesize those together and create one organization that's working towards the same direction?
Sure. I'm going to start with a quick clarifier on your question. The phrasing of a lot of our competitors really speaks to one vertical where we're a leader, which is probably, I'm assuming, the restaurants vertical. Because when you actually look at our other 3 verticals of leadership, stadiums and entertainment, lodging, and now luxury retail, our competitive set within those verticals is much more benign. And it's areas that we are very strong market leaders within. So if I was to isolate on just the restaurants vertical and take your question of what is essentially the distribution, or we'll say distribution method point of difference. We talk a lot about the idea that within a vertical, we can take an inorganic approach of acquiring a business that has funnel capability or funnel expansion opportunity, capabilities enhancements, and it opens up markets. Once we have that position of an acquisition that gives us those things, within that acquisition, we now have a very unique seat with which to cross-sell our payments capability into. And we might do that with a deprecation of the existing revenue streams, whether they're software, whether they are other fees, in exchange for what we believe to be a much stronger form of revenue in payments. This idea of cross-sell being a component of how we win from a distribution standpoint, because we're selling through the position of incumbency and giving more value in integrated payments and likely upgrading the solutions that they're utilizing, that to us is one point of difference. It's not to say we don't use the other methods of distribution as well. We do. We absolutely have a very strong distribution motion that allows us to go out and win in the open market within these industry-leading verticals. But at the same time, everything should be adjudicated on relative return for a unit economic dollar deployed, right? The relative CAC in the cross-sell is superior in our minds to the open market. So when you think about your question of if competitive intensity rises, how does that impact? Well, actually, it would just tell me that on a relative basis, it's likely that the variance between my unit economic returns and my cross-sell to what's available in the open market probably got even better.
Well said, Chris. Thank you. I think we have time for one more, if anyone would like to jump in. Here we go.
Hey, thanks, Chris. You guys have done a lot of acquisitions. You talked about how the pipeline for gateway volumes is currently as big as it's ever been. Something that Shift4 has talked about historically is kind of using the carrot and the stick of kind of harvesting that over time. Can you maybe talk about whether this current gateway volume, as big as it is time to maybe go back to that carrot and stick strategy, or is there more kind of farming of the top of funnel that you're looking at?
Sure. So let me one clarifier. When we talk about the funnel, we're not just talking about gateway. We're talking about the variations of funnel that come from anything from gateway to point of sale to gift loyalty to tax-free shopping, right? These are all various products that have a unique ability to influence the procurement of payments. That's what makes them really attractive to us. Because our North Star is about the payments. From that position, you have to do a very important analysis of what's going to work best within a gateway cross-sell versus a tax-free cross-sell versus a POS cross-sell, because they are not created equal, and different strategies, and depends on the market you're into, like different strategies are going to work well in different permutations of market meets vertical. So I think if your question is, will you utilize more carrot, more stick to me, it's a nuanced question that you have to unpack by the situation. But we are utilizing kind of all of the variables that are inside of our playbook, and we have a lot of data to tell us and guide us into what playbook to use at a given time.
Excellent. I want to say again, thank you to Tom and to Chris for being here. Big part of our conference, many years in a row. So thanks, guys. It was a pleasure doing this with you, Chris.
Awesome. Thank you very much, Tim.
Boom. Oh, no, la, 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 la. I don't want, I hate that they just start playing copywritten music. Holy. The best part about that, it started dumping. I didn't hear anything that was materially bad. The stock started dumping, and then it reversed on guidance talk. Okay. There was a part where Chris ended up saying that they sort of had three, they showed off in their last investor day. I think that was June of last year, something around that time, where they had three sort of real guidance outlooks. One of them, like they said, was the sit on their hands. The next was sit on their hands with the Global Blue acquisition. And then the third was continue to perform as we've been performing. So far, it looks like they've continued to perform. Okay. Which holds them up to about a 30+% CAGR, roughly. So, yes, we are no longer listening to Shift4, thank you. We will be listening, however, to Chime next. That is only in 7 or so minutes. So, really, honestly, I'm excited to hear this one. This one is pretty exciting. I wonder if there's a possibility for them to accelerate their growth and for, us to potentially see that Chime could be, up 50%, up 100% over the next little bit. They are materially cheap versus their competitors of, SoFi and Hood. Now they're not profitable, but their long-term goals are honestly much, much larger than, well, I shouldn't say long-term, more like midterm goals. SoFi at an end point wants to get to sort of about a 30 or so adjusted EBITDA margin, 35%. There's some analysts that put it as sort of a 40% target. Chime is wanting to essentially get to anywhere between 40 to 50% adjusted EBITDA margins, because they're bringing in for next year adjusted or incremental adjusted EBITDA dollars. Well, long term, if you can continue to supply those numbers, their current rate, which I think is like at 5% or 4% adjusted EBITDA numbers, would slowly go to that 50% if you continue to put up every new dollar at 50%. So nothing happened with SoFi. Everyone's freaking out. It's just the market. It's just, sometimes the market takes breaths. It's okay. We're not even like it's not even that big of a move. People are making it out to be like, we fell 5%. It's a slight downtrend. We're heading back. SoFi is better no matter what. Well, I don't agree with that. Not no matter what. I am married to No Name. Someone also just DM me. British, was this you? British sent me a DM on Discord, and it was someone asking, it looks like on Reddit, if they're going to enter things like prediction markets. And the official SoFi account on Reddit ended up saying, we've evaluated prediction markets to see some potential in how they could help people engage with events that impact their money. It's an interesting space, but we can't share a timeline at this stage. We can't share a timeline at this stage. I DM'd your feet pics. Did you get them? I did not get them. No need to resend. You keep them yourself, brother. That's all right. But hey, I do think prediction markets will be through all financial brokerages. Maybe not the sports stuff. The sports stuff might be Robinhood exclusive. Maybe SoFi shouldn't do that. But things for interest rate decisions, for certain prediction markets, that could be quite interesting. I know the amount of people that have come in chat to say what's going on with SoFi, and by the way, it's recovering. But first of all, there's no volume here. It's not a big volume time of the day, and then even then, like, we're recovering. It's okay. Little deep breaths here. Okay, Chime is in 3 minutes. It's going to be kind of back to back for all of these. Now they are they're much shorter, and hopefully, not hopefully SoFi is shorter. Hopefully we get a lot of good information there. But it's so funny how Chime is like no one cares about this company at all. And the way that I usually find these presentations is I go to their investor relations page, and they're not even like, it's actually hard to find Chime's investor relations page because it's that, like, it's like a page 3 on Google. Like, no one is searching for it. You type in NVDA, it's the first thing on the chart. Okay. We live for days like these. So funny. 5 minutes ago, before SoFi was running up, everyone's like, what the heck is going on? Now we're all green. Everyone's like, SoFi's the best. No, but Andy, I know what you're saying. You're saying a ton of new information, fireside chats. That is, we do live for those days. Okay. Let's get into the Chime event. Any interest in entering C Limited? Yeah, there's definite interest. I don't know if I want to pay the current price. What's the market cap of C Limited right now? It's pretty high, isn't it? Yeah, 80 billion. Like, I don't believe I've missed it, but a lot of the alpha has definitely been taken out of that name. I was following it before. I was honestly a pretty decent follower of C Limited, trying to look at all different types of fintech names. But, C Money was doing well, or at least it was called C Money at the time. Shopee was doing really well, but Granera was not. And Granera Free Fire was really like the only game. Now I'm pretty sure they have like Call of Duty and all those names. But Granera was kind of falling behind. So there was like certain aspects of their business that were not sort of kicking. So, but obviously that's turned around, and C Limited has had quite the change in their price, gone from $34 a share to $134. That's incredible. Okay. Now, let's listen to Chime. It's on now. We'll switch over.
Global Technology and AI Conference. We're very pleased to have with us today the team from Chime. Two members of the team joining us today. We have Matthew Newcomb, the CFO, who is here on stage with us. And we also have David Pierce, who is the head of investor relations, who is here in Arizona as well. So we want to say, starting off, thank you to both of you for making the trip here and being a big part of our conference.
Thank you for having us.
All right, excellent. Well, I think many in the audience here, just looking across, are very familiar with Chime. But for those maybe less familiar, just digging into the company, or those maybe on the webcast, maybe we can start with the intro to the company.
Sure. So we believe there's a secular shift happening in mainstream America towards digital banking that is helpful, free, and easy. And we believe Chime is very much leading the way, leading the charge on that. We created Chime to help the nearly 200 million US adults making up to 100K unlock their financial progress. And this is a segment of the market that I think has been very much overlooked by the incumbents, and it's working. So 97% of our members tell us we have helped them unlock their financial progress. J.D. Power just came out with a report showing that more people in America are opening up checking accounts at Chime than any other institution. Among people making up to 100K, we're the #1 destination for people switching their direct deposit relationship. And finally, Time just named Chime the #1 bank brand in America. We're not even a bank. And we're serving a broad segment of this market. In fact, people making over $75,000 a year are our fastest growing segment. And I think if we're to sort of zoom out at a very high level for a second, the playbook that we're using, I think, is very similar to digital disruptors in adjacent categories, whether that's Amazon and retail, Netflix and entertainment, Uber and transportation. We are maniacally focused on solving critical needs for our customer base. We've radically innovated on cost structure, which enables us to deliver better value back to the consumer. We've earned some of the deepest levels of engagement and trust in our category. And I think what that does is it allows us to be a real platform business. We're not a single point solution. We're actually helping our members across multiple areas of their financial lives. And I think it's very, very much still early days for us on that playbook.
All right, excellent. Well, one of the hallmarks of Chime is your primary account relationships, right? Industry leading by far. So you've made a point to highlight some of these, and maybe you could talk a little bit about some of the benefits of these relationships, both for you and for the members. And then more importantly, how are you able to convert some of your members over to this primary account status?
I think we have had more success in this area probably than anybody else in the ecosystem. And I think at the core, what has enabled us to do that is this track record of product innovation. We, again, have been really maniacally focused on the core needs of this segment of the market. Historically, that's been products like Get Paid Early, Spot Me, our fee-free overdraft product, Credit Builder. I think you've seen our product velocity increase over the past year with launches like MyPay, Chime Plus, Instant Loans, fee-free tax filing. But I think maybe most exciting is the product velocity still ahead for us now that we have transitioned to Chime Core, which is our proprietary in-house payment processor and ledger. The first example of a product that we've launched on this new system is Chime Card. And we've also got lots more in the hopper for next year across joint and custodial accounts, investment products, and even more premium membership tiers. And so, primary accounts really drive our business. They give us a tremendous amount of engagement. Our average active member does 55 transactions with Chime per month. It drives habitual recurring spend. It enables us to drive high levels of RPAM without relying on fees, and also incredible longevity in our cohorts. There's data out there that suggests the average tenure of a primary checking account is 15 years or more. We haven't been around that long. We don't have cohorts that old, but we do have cohorts that are now approaching 10 years, and they have not asymptoted. That really is the power of owning a primary account. And again, in an ecosystem of a lot of point solutions, it's enabling us to really be a platform. We're serving our members across multiple areas of their financial lives. Our tenured cohorts now use 4 products on a monthly basis. Their RPAM is closer to $350 compared to $250. And that's just on our current product set. Lots more to do for our members over time.
All right, great. Thank you, Matt. Let's talk about, you touched on this actually earlier, the 75K number and how that portion of your customers is growing faster. Maybe you could talk a little bit more about what you're doing to meet the needs of that higher earning group of customers.
Yeah, so first and foremost, there are 200 million people making up to 100K. There's another 30 million people in the US making between 100 and 200K. And we serve a broad segment of this universe today. I think in the past, there's probably been a little bit of a misconception that we serve the unbanked. That is not true. We serve the unhappily banked. 90% of our members come from prior banking relationships when they come to Chime. If you really look at the financial reality of this segment of the market, the reality is that a broad segment faces real financial challenges. 2/3 of America lives paycheck to paycheck. Even among people making more than 100K per year, about 50% of them live paycheck to paycheck. And so that's why I think our products, Credit Builder, getting access to short-term liquidity, no fees. That's why it's resonated with such a broad segment of the market. That being said, it is certainly true that as you move to the higher end of the segment, there are other value props that rise in importance. It is why we have things like high yield savings. We offer 3.5% on high yield savings accounts, 8x the national average. It's why we just launched Chime Card, which offers rewards, 1.5% cash back on rotating categories. It's why next year we're going to launch things like, again, joint and custodial accounts, investment products, even higher membership tiers. And so we are having some success with this. As I mentioned, as you mentioned, 75K plus is our fastest growing segment. And we're serving them well too. We retain this segment of our member base at essentially the same rate as our average active member. So there's no real notion of members moving on from Chime or graduating from Chime. In fact, it's quite the opposite. Our members are growing with Chime. And I think you see that in our cohorts where they adopt more products over time, and we're able to drive higher RPAM, rates of RPAM over time as well.
All right, excellent. We're going to go to another big topic for Chime, which has been the ungating efforts that have been going on for the past year or so. Maybe you can share more about why you decided to pursue this strategy, this ungating strategy, and what have the benefits been thus far?
Yeah, so historically, we've been really focused on earning and bringing our members into Chime and having them adopt us as a primary account right out of the gate. And I want to be clear, that remains our focus today. And as I mentioned earlier, we are the #1 destination among people making up to 100K, switching their direct deposit relationship in the US. That being said, doing that's kind of like getting married on the first date. And we know that that doesn't necessarily work for everybody. People might want to try before they buy. But the Chime experience as a non-direct depositor hasn't really been that good, to be honest. We haven't really given members a lot of reason or ways to try before they buy. And so we felt like we were just leaving some opportunity on the table. So we've made a deliberate effort over the last year or so to make it easier to get started with Chime. We've done things like ungated certain value props from the direct deposit paywall. So now you can get credit builder without being a direct depositor, as an example. We've made it easier to fund your Chime account with a debit card instantly, with Apple Pay, with mobile check deposit. And these things are working. They're already having a positive impact on our business. We're seeing some of the highest first-time activation rates among new enrollments that we've ever seen as a company. That's helped us accelerate our new member growth. We've added 1.6 million new actives over the last year. That compares to 1.2 million for the prior 12 months. That's helped us bring down our CAC. And at the same time, we're also monetizing these yet-to-be primary accounts in a more material way. The transaction profit per active member that's not yet a primary account is up about 20% versus where it was a year ago. So all this amounts to actually better unit economics. Our recent cohorts are tracking to 5 to 6 quarter transaction profit payback versus 7 quarters or so previously. So it's already having an impact. I will say though, ultimately the goal is the same. The goal is to convert these members to a primary account relationship over time. And we're actually seeing some early success with that. We're seeing a increase in the number of people that are converting to Chime at a later stage, late stage conversion to direct deposit. We think there's still lots more we can do there. So, I think zooming out, the way to think about this is an important evolution of our new customer acquisition funnel, but it's just that. It's an evolution. It's not a change to the ultimate strategy of earning primary account relationships that drive this very sustained return ROI on our new customer acquisition spend, 8x LTV to CAC. That really remains the core focus of the business.
All right, excellent. We're going to move on to another topic. You alluded to this earlier, but we can expand upon it. So the competition with the incumbent banks, which is really who your primary competitors are. Maybe talk a little bit about that. Specifically to that, one of your tools to compete, as we know, is Chime Core, right? So maybe you could talk a little bit about what Chime Core means and how it benefits you in that competition, but then also some of the financial aspects associated with Chime Core as well.
So we like to say that we fish where the fish are. And the reality is that pretty much all primary accounts in America sit at the incumbent banks. And we feel like we've got some real structural advantages that are enabling us to compete so well with these institutions. The first is cost structure. One of our nation's leading bank CEOs, in his shareholder letter earlier this year, said that the cost to maintain the majority of his accounts is higher than the revenue that he earns from them. In contrast, we have a $250 RPAN that we monetize at roughly 70% transaction margin. Our cost to serve is about a third or a fifth that of an incumbent bank. I don't know if there's a better summation of our opportunity, honestly, than that. And Chime Core, to your question, has played a key part of this. We've now transitioned our portfolio entirely to Chime Core, again, our own payment processor and ledger, and that's reducing our processing costs by over 50%. The second advantage is really around our focus on serving the needs of this customer segment. We are not trying to say that the traditional banks are out to get the everyday person or the mainstream American, but they just don't have a lot of incentive to innovate for this customer when they're upside down on their unit economics. And I think the product experience and product suite really shows that. That's all we care about. That's why we've been so focused on launching things like SpotMe, Credit Builder, Get Paid Early. These are the things that matter most to everyday Americans. And then lastly is brand. We now have unaided awareness that is rivaling essentially the top 3 banks in America. But I think more importantly is that everyday folks think about Chime, are more prone to think about Chime as solving their most critical financial challenges. They really are thinking about us as the key for their primary financial needs. So yeah, these are some of the key advantages. I think the other piece of Chime Core is that it's enabling us to innovate faster. I talked about product velocity. That is a key piece of how we think Chime Core is going to really stand us in good stead going forward.
All right, Chime Core covered well, thank you. Let's move on to another exciting topic for Chime, which is Chime Card. So you talked about this a little bit earlier as well, but maybe talk a little bit about what you're seeing with this product and talk about the benefits that the company could see over time. And then if you don't mind, I'll have a quick follow-up.
Yeah, so Chime Card is our latest innovation. Again, we built Chime Card on Chime Core. It's really the first product that we launched on the new the core system. And the way to think about it is it makes banking with Chime that much more rewarding. So Chime Card is a secured credit card, and it offers direct depositors 1.5% cash back on a rotating set of categories. It also comes with a premium card design, and of course, as a secured card, helps our members build their credit. This really comes on top of all the benefits that you get from Chime Plus available to direct depositors, like fee-free credit building, early access to your pay through MyPay, free overdrafts, 8x the national average high-yield savings rate, priority member support. This is a combination of value props that is just unmatched relative to what you could get in an incumbent institution. And so we're quite excited about Chime Card across a few different, actually, dimensions of growth. The first is take rate. So Chime Card is a secured credit card. Net of rewards, it earns about 175 basis points on transaction volume. That's about 50% higher than our average take rate in the portfolio today. The second dimension is new customer acquisition. We think Chime Card is essentially a great new customer acquisition tool. We're just starting to promote it now. You'll see it in some of our holiday ad campaigns, so stay tuned for that. And then third is engagement. Rewards on Chime Card are only available to direct depositors. And so we think this is a great additional incentive for people to bring more of their financial lives to Chime, spend with us, and then get the benefit. This is part of a broader strategy, again, to help our members understand that as they do more with Chime, they get more with Chime. And so we're quite excited about some of the early results among people who are adopting this product, new cohorts of members. They're using it for about 80% of their spend. So it's early days. We have a lot more to do. It's a very new product, but we're very excited about this as a growth lever.
Great, thank you. And that follow-up is, so if a new member were to go to Chime today and sign up, can you talk about the onboarding flow and how this card is presented to them, and maybe just directionally the proportion of new customers that are adopting the Chime card?
Yeah. So if you are a new customer coming to Chime, in the onboarding flow, you're going to see Chime card first. That is now the primary option that we are surfacing to you as a customer. Kind of all the benefits of the existing product, but of course, with rewards, the ability to build your credit, and a new premium card design. So as a result of that, we're seeing pretty solid adoption rates among new cohorts of members coming in to Chime. There's always going to be a portion of members that prefer debit. That's just a sort of secular reality. But by surfacing this early in our members' journey, when they're just under habit formation, we do think there's a great opportunity to drive attach rate on this product among new cohorts of members. Existing members, we are also beginning to give them the opportunity to adopt this product. They're a little bit deeper in their habit formation. That's probably a little bit of a harder piece to solve, but it is something that we're also going to work on over time as well.
All right, excellent. Let's move on to some of the liquidity products. So clearly Chime is a payments-based business, right? You're driven by largely non-discretionary everyday spend, but in the recent past, you've moved a little bit more into some of the liquidity products, such as MyPay and instant loans. And maybe you could just talk a little bit about the advantages to your business for offering those. And I would preface it by saying, the way we, my words, not yours, the way we like to describe it is it's CAC that pays for itself and then some. And it certainly drives the core business and the core revenue.
Yeah, so you're exactly right. The core of our business is this asset-light, payments-driven business focused on non-discretionary spend. So 2/3 of our revenue comes from interchange-based fees, and about 70% of the transaction volume driving that revenue is in non-discretionary categories. The biggest ones being gas, groceries, restaurants, the type of spend that I think sticks with you really regardless of the macro environment. I think that gives our model a ton of resiliency. At the same time, when you own direct deposit relationships, you do get tremendous advantage in offering members access to short-term liquidity for a couple of reasons. One, we have a ton of data on our members. We see essentially all their inflows and all of their outflows. And number two, we have a privileged repayment position. We are essentially the top of the repayment stack. We offer our members access to MyPay, to SpotMe, to an instant loan. The next time their direct deposit comes in, we get paid back first. And that is a fundamentally different risk profile than I think is typical or at least the way people typically think of consumer credit. In some ways, the way I would say it is we sort of flipped. We've sort of done a 180 on the way that these businesses often work, which is typically you think about the sort of top of the funnel adverse selection game. We acquire a direct deposit relationship first and then only offer those members access to liquidity. So again, this is a very different risk profile. It's very short duration. SpotMe repays in less than a week, MyPay in less than 2 weeks. It's small dollar and highly diffuse, and again, underwritten by direct deposits. And so, I think we've got a lot of advantages, and what this essentially amounts to in the end is an ability to price our products very competitively while keeping our loss rates low and our risk profile low. And so today, these products are about 20% of revenue. We think it's an awesome opportunity of continued growth for us, but I wouldn't go so far as to sort of think that Chime's going to transform into a lend-centric or balance sheet heavy business anytime soon.
Excellent. All right, covered very well. Let's move on to the next one. This is kind of an industry question, kind of a Chime-specific question. So a little bit of the state of the consumer and then the resilience built into the very non-discretionary spend associated with Chime's business model. So sometimes there's talk of this K-shaped recovery in the economy or K-shaped economy, but you guys shared that on your Q3 call, at least at that time, that you were seeing resiliency. Maybe you could talk a little bit about what you're seeing thus far throughout the quarter and then longer term, that resiliency built into the model.
Yeah, so we serve obviously millions of people in a primary account capacity. And so we think we've got a pretty great real-time view into the state of the everyday consumer. And I do feel like we've been a broken record on this, but the gist of it is we just continue to see a lot of resiliency despite all the headlines around this. You know, we talked about how non-discretionary forms the majority of our spend, but discretionary continues to hold up well. In fact, it's growing faster than non-discretionary. You know, we saw, for example, in Q3, a number of quick service type restaurants talk about lower foot traffic. And they kind of alluded to that being macro driven. We look at our data for those particular names, we see the same thing, but we don't see it for restaurants as a whole. Restaurants as a whole have been very resilient and steady and continue to grow at a very steady rate. So we're not quite sure that's macro related, I guess, is one way to say it. We just had Black Friday. Black Friday too was very much in line, I think, with what you're hearing from others. You know, a solid report. We took a look at you know, apparel and merchandise spend, and that was up among people shopping on Black Friday about 10% year over year. That was a little bit higher growth than what we saw last year. So overall, again, very steady trends on that front. You know, beyond spend, we also see a lot of steadiness in employment. We have not seen, despite, you know, even this morning's report from ADP on payroll, we've not seen an uptick in unemployment insurance coming into Chime. Account balances continue to grow year over year. Usage of our liquidity products remains very consistent. Loss rates very consistent. So again, a lot of steadiness in the business. And you know, just the thing that zooming out, what I would say on this too is just you know, we just have a model that I think can work well both in good times and in tougher times. Again, non-discretionary spend. To the extent that there is joblessness and our members receive unemployment, it's probably going to come to Chime. We're their primary account. We saw this in droves in the early stages of COVID. Our liquidity products are very short duration, so we can very nimbly adjust if we do see a blip in the night. And I think, you know, more broadly, oftentimes when times are tougher, people sort of take stock of what they're spending on and are a little bit more thoughtful about that. We feel like we're the lowest cost producer in this category, the lowest cost options in the market, and in many ways stand to benefit when times are tougher. They need things like access to short-term liquidity, credit building, even more. So good in good times, but maybe even great in tougher times.
All right, excellent. We're going to move on to another exciting topic, which is Chime Enterprise. So you've already announced a few big partners, including Workday. Maybe talk a little bit about these and how they fit into the overall strategy with Chime Enterprise.
Yeah, so as a reminder, we acquired a small company called Salt Labs late last year. Salt Labs was founded by the founding team of Daily Pay, which really pioneered the earned wage access B2B space. And so with that acquisition, we established Chime Enterprise, and the goal of Chime Enterprise is to sell the suite of Chime products as a holistic financial wellness solution to employers for them to offer to their employees. And what's exciting for Chime is that this, we believe, offers us a chance to establish a new strategic, low-cost, and kind of evergreen channel for new customer acquisition growth coming to Chime. Early days, we're excited by the progress. So we've announced you know, a couple of initial partnerships, both with Workday and UKG, obviously large human capital management platforms. The way to think about that is that this really enables any Workday or UKG customer to pretty seamlessly switch on Chime Enterprise to offer to their employees. And then we've also announced 3 direct deals with employers. So Ubiquity, eTech, and a company called Maxwell Group on the smaller side so far. And you know, those companies are still ramping up. Employees are adopting the product, but I would say, you know, right out of the gate, the adoption that we've seen has surpassed our expectations. We've been really excited about that. And I think what makes us excited about this as a category going forward is we think we've got a couple of really strong advantages to compete. Number one, most of the players in this space are kind of monoline players. We're going to market with a full suite of services. Number two, cost. My Pay at Work customers get access to up to 100% of their earned wages for free. That is very different than the monoline players that are charging upwards of $40 a month sometimes. And then third is our brand. When we go talk to some of these employers, a high single-digit percentage of their employees are already banking with Chime. So we're sort of a recognized brand. And so, we're really excited about this. This is an enterprise sales cycle. It takes time, but we're excited about the pipeline and more to come on that.
Excellent. All right. Well, in the time that we have left, maybe we could just group the final two questions together because they kind of go together. But we'll talk a little bit about the growth framework. You've highlighted many of the drivers during this presentation, but maybe just highlight some of the growth levers that are most important to you, Matt. And then lastly, around your AI efforts and how they relate to operating leverage and some of your potential long-term profit margins.
Yeah. There's really two big growth levers in our business: active members and RPM. Actives today, we've got 9 million. There's 200 million people making up to 100K. Just getting started, we think we've accelerated our pace of active member growth. We've added 1.6 million over the last year compared to 1.2 the year prior. We're very excited about new product initiatives, including enterprise, to continue to drive growth. On RPM, when you own a primary account relationship, you are in this very unique position to be able to cross-sell additional products. And I think we've proven that over and over with high yield savings, with Pay Anyone, with SpotMe, most recently certainly with MyPay, which grew from 0 to a $350 million revenue run rate product in a year. That's really the power of having a customer relationship that is in the app every single day, again, transacts with us 55 times a month, and thinks of us as their central financial hub. And when you put those two things together, again, you get this cohort performance that almost looks a lot like a subscription business. It just continues to spit off transaction profit year after year. Again, cohort's now 10 years old without ever asymptoting. And so we're really excited about, still being early days across, I think, both of these dimensions. On the AI side and margin side, I think if you were to boil down the unit economics of our business, what we're essentially doing is we're scaling a highly recurring portfolio of payments revenue that monetizes at roughly 70% transaction margin, retains on a net dollar basis above 100% year over year, over a largely fixed expense base. There's a lot of operating leverage in a model like that. And I think you've seen that from us. You've seen adjusted EBITDA margin grow substantially. You've seen OpEx as a percentage of revenue come down substantially. And we think that's only going to accelerate from here, partly because of AI, and partly because we now have this major migration to Chime Core behind us. On the AI side, I think where we're seeing the biggest impact of the business today is in our customer support function. So we launched a Gen AI chatbot in Q1, a Gen AI voice bot in Q2, and most recently in Q3, we pointed Gen AI at one of the most labor-intensive parts of our customer support function, which are dispute investigations. And the impact is awesome. It is basically cutting agent handle time in half, but it's also providing a better member experience. It's helping our members get their disputes resolved more quickly. And the impact of that, the numbers sort of speak for themselves. We've seen the highest customer service NPS scores that we've ever seen as a company in Q3. And so we're just at a point now where we don't feel like we need to grow our OpEx base as quickly as we have historically to meet our ambitious growth targets. We're going to keep headcount roughly flat over the next year. And you should expect to see that translate to an accelerating, profit margin story. 9 points improvement in Q3. We expect 11 points improvement to adjusted EBITDA margin in Q4, mid-50s incremental, which we expect to grow even further in 26.
All extremely clear. Matt, excellent job. Really a pleasure having you up here and having both you and David here in Arizona. So thank you so much for being a big part of this event.
Thanks, Tim.
Very cool. Honestly, I know not everyone is interested in Chime in this chat, but that was really encouraging for me. And my sort of take on Chime almost every single day has improved. And unlike the fireside chats of before, Shift4, PayPal, all syncing on that chat, Chime was just going higher. So the rest of the market really liked it. I love the investment in Enterprise or Chime Enterprise, which is essentially a version of SoFi at Work. They are going full force into credit cards, secured credit cards. So they're not taking on any risk, secured credit cards, but that boosts up the interchange revenue. Okay. So higher take rate, higher revenue, better margin. That's amazing. And with that, they're offering a bunch of improved, rewards to try to attract users to use those new products. I think that's all very good. Now, he also was talking a lot about AI and how that's helping with customer support and things like this. Like, I love to see these new tech companies. If you want to call yourself a tech company, what technology are you integrating? So I'm aware that this name is not your favorite. And if you're buying long term, I still you can still go head on into SoFi more and more and more, but you should still listen to Chime to see, one, was it worth it for them to switch off of Galileo? If it was, and they proved that to the market and they're not coming back, that could scare investors in the Galileo trade. Okay. So it's good risk tolerance for SoFi, understanding the risks. Then, how are they doing with direct deposits, secured credit cards, like Chime for Enterprise, like learning all the different things that they're doing is also good to know what direction SoFi is heading in. So even if you're not interested in learning about Chime, it's still good if you're sort of a all-in SoFi kind of person. Trump's talking. Honestly, I don't care. I don't know what he's talking about, but we have SoFi's Fireside Chat at 3:35. That's in 7 minutes. That's going to be my focus. And then I can listen to what Trump is talking about after that. But yeah, I mean, I'm up like a little over 30% on this trade since buying it not long ago. like we were buying sort of in this range here. I'm up 30% already. I think that there's a lot more to go here, and people are worried about sort of comparing one to one. The valuation of Chime is essentially like 1/3 as cheap as SoFi. Chime is as predatory as the rest of the payday loan fintech movement. Okay, so you don't invest. I don't agree with you. It's not even remotely true. And just avoid that one trade. But to me, that's a load of horse crap. Is Chime just a trade for you? It's a trade right now. But a sort of longer term, this is a 6 month. I think this is a 6 month play for me. It's true. Take a look. Okay. That's fine. Why is SoFi dumping like this? Let's see. Down 1.2%. We'll see what they're like after the Fireside Chat. But yeah. I'm not sure why. Everything that I'm seeing in the macro, so the call's in 5 minutes. Everything I'm seeing in the macro is that, Kevin Hassett's most likely going to be the next Fed chair. Quantitative tightening is over with, which is a form of quantitative easing. That's good for SoFi. A rate cut potential on December 10th is at a 90% chance. That's good for SoFi. They are most likely in 5 minutes going to say that the consumer's extremely strong. We're seeing no change to credit, and we're seeing more institutional demand than we ever have seen. That is what I'm hoping for. If that happens, the stock can do whatever it wants. I mean, drop another 3%. I'll buy more. I'm not worried about... So the only time that you need to worry about the market and what they're thinking on a day is that if you have ignorance in the name or something. Like you don't know it very well. But if you know what SoFi is doing and you know how well they're performing, why panic? You know? I held this from $9 down to $4. That's that's panic. I'm not worried about going now that we're 29, who cares? How is any app predatory or something if a consumer decides to consume? Well, I think that misrepresenting some interest rates, like I see this all the time with some actual predatory, like the word predatory is overused in this context. Predatory loans is like whenever you go to take out a $10,000 loan, they say, hey, your interest is only $100 a week. And they break it down into like weekly terms or like small dollar amounts. So then you don't think about the APR. Those sort of tactics are completely predatory. And then they end up charging you like 35% APR for your small dollar loans. Well, that's not really small dollar loan, but like for a personal loan, absolutely insane. For instant withdrawal tactics, I mean, aside from SoFi, name a fintech that isn't doing it. PayPal, Cash App, Chime, what's called Dave, all of them do instant withdrawals. Robinhood. So are they all as predatory as actual payday loan lenders? Let's put it into context. You're worried about the tipping thing. It's a tip. So put zeros. There is an interest rate for taking, if you want to look at instant withdrawals as taking additional money, yes, it's high, but every single company is doing it. But you're comparing it to the absolute worst companies in the industry, like Go Easy or Cash Now, these local like brick and mortar companies that are charging you 40% APRs. It's not even remotely comparable. But yeah. All right. SoFi is coming up. Let's make sure that we have the website thing. Now, if you are worried about predatory companies, SoFi is pretty good. They still offer credit cards with higher APRs than, that guy in chat would be able to stomach. Is any credit card company a predatory business? I don't know. So, but yeah, they do not. They're probably one of the better ones because they don't have instant withdrawals and they don't have those types of fees. But also, if you want instant withdrawal, there's no way to get it. So what's better? Would you rather pay for a product that you have the option to take or not have the option to take any sort of product because it doesn't exist? I'll let you guys decide on that one. Okay, we still have music. Let me go ahead and send out the tweet that we're live now. This banner thing I got to change. Currently listening to SoFi. All right. And let's see. Okay, still music, but it should be turning on any second now. Yeah, okay, it's on. Let's go.
Here today, as well as Investor Relations, Mike Iannelli and Michael DeGrosso. So I'm Jill Shea with UBS, and I'm joined with Tim Chiodo, who co-covers SoFi with me. So I'll turn it over to Tim to kick us off.
All right, we're going to start with the recent update and Q4 quarter-to-date trends. So you recently raised the full-year guidance, basically across the board: revenue, EBITDA, income, EPS, and total members. Maybe talk a little bit about some of the parts of the business that have really been driving that.
Sure. And first, Jill and Tim, thanks for having me. I really appreciate being here again. So in terms of overall performance year to date, it's been a great year so far in 2025. Really strong operating trends across the board, a number of records. It's really been a testament of the strong brand awareness that we have in our product, really unique product innovation, and continuing to iterate each and every day. We've been raising our guidance throughout the year, and most recently, again, heading into Q4, we now expect to add over 3.5 million members on the year and generate $3.54 billion of adjusted net revenue, which represents about 36% growth. Like I said, that's a testament to the unaided brand awareness that we've been able to achieve and product innovation. This past quarter, we reached a record high at 9% versus where we were back in 2019, 2020 of just low single digits. In terms of some of the segment level performance and what's exceeding expectations, within lending, we're seeing really good momentum in renewed interest in student loan refinancing as well as home loans. And we're having a really strong year in unsecured personal loans. But what's really been the game changer for us in terms of outperformance has been our financial services business, where we're seeing really strong trends across the board within interchange and brokerage fees. Both of those are up 70% year to date. And then the real game changer for us has been our loan platform business, which is up 4x year to date from just expanding less than 4 quarters ago. So really good momentum across the board that we're seeing. We're also have made a deliberate shift into focusing on fee-based revenue sources that are less risky, capital light, high ROE. This past quarter, 40% of total revenue was fee-based revenue, up from where we typically have been at about 25%. So good momentum there that we expect to continue throughout Q4 as well.
Excellent. Well, one of the standouts to us was the cross-buy. So reaching really its highest levels in the past few years, about 40% of new products open were from existing SoFi members. Maybe talk a little bit about that in context of your one-stop shop strategy.
Sure. It's a demonstration that our one-stop strategy is really working. So we talked a little bit about unaided brand awareness. That obviously brings people into the funnel and into the platform. But what really drives cross-buy is having unique, differentiated products that work better when they're used together. This past quarter, we were at 40% cross-buy. That's our 4th consecutive quarter of having increasing cross-buy rates. And again, that's a testament to the quality of our product and innovation. In terms of where the cross-buy is coming from, it's a number of places across our SoFi Money and SoFi Relay product. Those are the tip of the sword acquisition channels for us, where about 1/3 of new accounts that are open are coming from those 2 products. And then the real beneficiaries of cross-buy are our Invest product as well as our lending product.
All right, excellent. Thank you, Chris. We're going to move a little bit into product innovation, first broadly, and then a few specific things. So you noted, and you clearly have plenty of room to do this in terms of accelerating some of the level of investment behind product innovation. Maybe just tell us a little bit about what's driving that and where some of those dollars are going.
Yeah, what's driving the overall investment and level there has been the market opportunity that we have across our entire ecosystem of products. This includes our products where we have really good market share, so our personal loans and student loan refinancing, where we're continuing to innovate and iterate and put marketing dollars behind, especially as rates start to come down, the total addressable market for student loans expands. Home loans, where we don't have a meaningful market share right now, or less than 0.1% of the overall market, is a huge opportunity for us. We've expanded our product set there. We now not only do first lien mortgages, but we do refis, we do jumbos, we do home equity loans. Home equity loans this past quarter represented about $350 million of our total $950 million of originations, and that's continuing to grow, and it's a great asset for us. So you're continuing to see us invest there, and there's a ton of headroom just given where our market share is. In some of our other products where we don't have a meaningful market share, there's opportunity continue to drive meaningful growth. That's in our deposit franchise with SoFi Money, where we have about $30 billion of deposits, 90% of which are from direct deposit members. But that's only a fraction of what's available in the market today, especially with the large money centers. Brokerage, we haven't put meaningful dollars behind our brokerage business because we want to ensure that we're variable profit positive on a unit economic basis. We're now there and have been for 2 quarters, so expect us to put more marketing dollars and investment behind that business. We recently rolled out level 1 options, which is going to be a key growth driver for us as well. And then you have all the new products that we're investing in, given some of the secular trends that we're seeing. We recently announced SoFi Crypto, a return to that, SoFi Pay, which is our global remittance product, and we'll soon launch our SoFi stablecoin. What I would say in terms of our overall philosophy on investment is that we've been pretty consistent in wanting to reinvest 70 cents of every incremental dollar of revenue back into the business in order to drive sustainable and durable revenue growth for decades to come. That overall philosophy has not changed. And we are certainly in investment mode given the opportunity set in front of us. One thing I would note is, and Anthony mentioned this a few firesides ago, the EPS guide that we gave for 2026, the low end of that range represents a high growth scenario. And we're certainly in that time right now. We're investing extremely heavily right now in all of those areas that I just mentioned. But we're also delivering meaningful and outsized returns. This past quarter, we're up about 300 basis points on an ROE basis relative to where we were in Q3 of 2024. Longer term, we expect our business to be a 20 to 30% ROE business. And the pace at which we get there will depend on top line growth.
All right, excellent, Chris. You just touched on it briefly, but maybe we could expand a little bit more on some of the crypto efforts. So you mentioned SoFi Pay and then also the relaunch of buy, sell, and hold. Just talk a little bit more about those specific offerings.
Yeah, we're extremely excited about getting back into SoFi Crypto and the recent announcement of SoFi Pay and the upcoming stablecoin initiative. What I would say on crypto, we just announced it. We're letting people off the wait list already. We're excited about that opportunity and the differentiated product that we're able to bring to market today relative to where we were several years ago when we were in the marketplace, primarily because it's permissible to operate as a bank in this space. 2 reasons that we're highly differentiated as it relates to the bank. First is we know our members trust and want to use a regulated entity to do their crypto trading as opposed to traditional exchanges that aren't regulated and don't have a bank license. We know that because we've surveyed a number of people and 60% of respondents have come back and said that they would prefer to use a regulated entity, which we obviously are. The second benefit is, and this is a testament to the hard work and effort of our tech platform team who has built great solutions for us, is that a member who wants to buy crypto on our platform will be able to transfer money directly from their FDIC insured checking and savings account on SoFi that's generating 3.6% interest to purchase that crypto. And they don't have to let their cash sit idly in an unregulated, non-FDIC insured account that's not generating any type of interest. And then third is we offer a bunch of educational tools to help our members make the best financial decisions, particularly when investing in this type of asset type. In terms of SoFi Pay, it's another example in form of selection in our unprecedented money movement capabilities. It leverages layer 2 blockchain network to do global remittance and send money in a much faster and lower cost manner than other providers can do. We're still in the very early days of this, but it's going to be a great product for us. Eventually, we will want to roll out SoFi stablecoin and utilize that through SoFi Pay and have that drive our overall global remittance effort, but we're still early days. And then as it relates to the stablecoin, we're really excited about that as well. Like I said, it will first help drive global remittance, but in the future, we're going to market this to large banks, mid-sized banks, large consumer brands who accept digital payments, as well as exchanges and market makers in the crypto space, who will essentially be able to wrap their consumer brand around our SoFi USD stablecoin. And they're going to end up choosing us because we're a regulated bank. We have access to the Fed window where we can put deposits that are tied directly to the SoFi USD stablecoin. And in turn for that, we could pay that interest back to our partners, who can either record that or generate revenue, or pass it on to their consumers and create a really unique value proposition. So there's a number of use cases that we will be able to have with SoFi USD stablecoin, and we're really excited about the opportunity.
All right, really appreciate that, Chris. I'm going to turn it over to Jill. We're going to move on to the loan platform business.
Thanks, Tim. So clearly a hot topic with investors, and it's clearly top of mind in terms of the loan platform business. You've announced a number of partnerships with Fortress and Blue Owl, among some others. Some of those agreements have details publicly disclosed, others do not. So maybe you can just help us think about the volume or cadence of the loan platform business. How should we think about origination volumes and just overall personal loan volumes as we go forward?
Yeah, like I said before, it's been a game changer for our business. We just started expanding beyond it being a referral business and a decline monetization funnel for us, to originating on behalf of others and really utilizing our marketing capabilities, operational capabilities, risk capabilities in exchange for a more diversified and durable revenue stream. So this past quarter, we did $3.4 billion of originations on behalf of others. We're now operating at a $13 billion run rate and generating $660 million of annualized revenue. If you were to look at just our announced partners, Fortress, Blue Owl, Edge Focus, that would translate to about $1.3 billion of originations per quarter. And like I said, we're at $3.4 billion right now. So that's a function of having a number of other partners on the platform, as well as seeing a bit of flight to quality, where existing partners are coming to us and saying they want to upsize their purchases over the course of the next several quarters. So really good momentum that we're seeing in that business. I truly think we're just starting to scratch the surface right now, because we're only doing unsecured personal loans through the platform today, and the vast majority of them are directly within our credit box and what we would otherwise hold on our balance sheet. A few quarters ago, we started to do stuff that we would not otherwise hold on our balance sheet, but it's still really good credit, but it's still a tiny fraction of what we could do. Right now, we're turning down about $100 billion of personal loan applications coming through the platform every single year. So even if we were able to capture a small percentage of that, 5, 10, 15%, that's a meaningful growth driver just for that business. In addition to that, we'd love to be able to expand beyond unsecured personal loans and offer other types of asset classes and go to our investors with a menu of options that allows them to pick assets based on their risk tolerance and investment profile. So I think we're just starting here. The demand is extremely strong from capital markets participants as well as borrowers. In terms of how we should think about the cadence going forward, we've said publicly that we think this could be a $1 billion business. We're well on our way to that in just 12 months. We'll provide more guidance on how we think about that as we get to our Q4 earnings call. But we did say that Q4, we would see an increase in LPB originations relative to Q3. We've seen really good momentum in that over the last several quarters. And then from a personal loan origination perspective, there is some seasonality in Q4, and we always expect that. Historically, we've managed through it, but there is a little bit of seasonality.
Great, that's helpful. Maybe just turning to the balance sheet, in light of the recent capital raise and very strong capital ratios, I think you're running about 20% now relative, well above your regulatory minimums. Can you just talk about the appetite to grow the balance sheet and what we should expect over the next year or so?
Sure. The capital raise that we did after our last earnings call was purely opportunistic and provides us with a lot of flexibility and optionality to grow the business both organically and inorganically, and provides a lot of optionality for us. We're happy with the pace of growth that we've been seeing recently. We would expect heading forward that we would grow the balance sheet at a good pace, and we'll provide more guidance on what we expect that to be coming out of Q4. But again, this is a great optionality for us.
And then perhaps just turning to student lending, you have made the comment that lower rates opens up opportunity for the student refis. Can you just elaborate on SoFi's opportunity in student refi and what it could look like when rates come down?
Yeah, we have a good opportunity. You've seen good momentum in that business over the course of the last several quarters. Right now, we estimate there to be about a $400 billion total addressable market within our credit box and where we can price our loans today. We estimate that a 50 basis point drop would increase the total addressable market by about 25%, and further decreases in benchmark rates could expand it much more meaningfully. So overall, good opportunity for us. Back in 2019, when rates were lower than where they are today, we were originating about $1.7 billion per quarter. We maxed out or peaked at $2.4 billion in Q4 of 2019, or about a $9.5 billion run rate. That was when we were a much smaller scale and we had lower market share. So the opportunity is pretty significant.
And then just in terms of the government decision to potentially stop funding graduate school loans, can you just talk about why those loans would be attractive to you, either from a rates perspective or a credit quality perspective?
Yeah, these would be great potential borrowers. These are people who have good credit history. They're well educated. Think of these as doctors, lawyers, MBA students, nurses, and very high average income. We estimate right now that the total addressable market for the Grad Plus program is about $14 billion. And given that we would be one of a handful of market participants and people who could originate in that space, we would have the ability to take our fair share of that.
And then turning to home lending, I think 2% of all mortgages taken out by SoFi members were actually taken out with SoFi. So what's the expectation for where penetration can go in 2026 and beyond, and how do you plan to drive that?
Yeah, I think there's two growth vectors for the home loans business. I think it's within our existing installed base, as you just alluded to, where we wouldn't have to pay a meaningful second acquisition cost. And then it's outside our existing installed base, where we have virtually very, very small market share. So outside of our marketplace, or outside of our installed base, we're less than 0.1% of the overall market. Even if we were to expand that to 1 or 2%, that's a meaningful growth driver for us. Within our existing installed base, like you said, only 2% of all SoFi members who have some type of mortgage take it out with SoFi. I think part of that is a function of expanding that, as part of that is a function of having the product set. We historically only did conforming loans and refis. We now do home equity loans. We're going to be rolling out home equity lines of credit and putting more marketing dollars behind all of this. I think the second part of it is brand awareness. A lot of folks don't know that we do home loans. So you're going to start to see us put more marketing dollars behind that as well.
And then maybe just zooming out here and turning to the macro and credit quality, you did see improvement in your net charge-off rates last quarter on personal loans and student loans. Now that we're about 2/3 of the way through the fourth quarter, do you have any update in terms of credit quality and overall health of the consumer?
Yeah, overall, our view has not changed since the Q3 earnings call. Really good progress and trends that we saw in NCO rates as well as delinquencies in Q3. We continued to bend the curve. NCO rates were down 20 basis points. Delinquencies rates were down. And everything is performing in line with expectations here in Q4.
And then just a question on funding and the margin. You're running your NIM at call it 5.8%, and that's well above your margin guidance of 5% plus. Can you just talk about the puts and takes on the margin, and also what are you seeing on the deposit side?
Yep, there are a number of puts and takes. The thing I would say is that we've been able to maintain a really healthy net interest margin. This past quarter was 5.84%, and that's a function of a number of things. First, we've been able to maintain really healthy asset yields in rising rate environments. We've proven that we've been able to raise rates and our weighted average coupon at a faster pace than where rates have gone. In a declining rate environment, we've been able to hold prices and not decrease them at the same pace as where rates have gone. So on the asset side, we've been able to maintain really strong yields. On the cost of funds side, we've been able to lower our overall cost of funds because we've been able to displace higher cost of funds through warehouse lines, brokered CDs, and other more expensive costs of funds. So it's a function of those two things that have enabled us to maintain really healthy NIM margins. The other thing I would note is that you can't look at the net interest margin in isolation either. We take a more holistic view to the member and are looking to drive the highest lifetime value for each and every one of our members at the lowest customer acquisition cost. And the way that we do that is by providing differentiated products, differentiated selection. Price is a really important form of that selection. We're right now offering an industry-leading APY of 3.6% if you do direct deposit. And unlike other non-banks, we have the ability to offer a higher rate, and we don't have to lower rates at the same pace as the Fed, and we can still offer a very unique value proposition and give that all back to our members because of the cohesive product set that we have built and our focus on lifetime value as opposed to any specific product or metric.
Very helpful. I'll kick it back over to Tim.
All right. Thank you, Jill. All right. We're going to move into a little bit on the financial services segment. So last year at this time at the conference, we were talking about annualized revenue per product at about $81. And now we're up to $104 as of the most recent quarter. So it's a nice big increase. Chris, maybe you could talk a little bit about the drivers of that increase over the past year, and then maybe more importantly, how investors should think about that number going forward.
Yeah, overall drivers of the increase in monetization of financial services has primarily been a function of the expansion of our loan platform business, where we're generating extremely good returns at a low customer acquisition cost. We're also seeing good momentum in spend behavior, with our interchange being up over 70% year to date, and brokerage fees, particularly as we've rolled out new monetization features like level 1 options. That will continue to grow as we expand the loan platform business and roll out crypto and other products.
Right. Thank you, Chris. All right. We're going to move to the tech platform. So revenue growth in that segment was up about 12% this past quarter, and it was driven by a combination of continued monetization of your existing clients, but also there were a bunch of new deals that were signed and a few that you called out. Well, one in particular was Southwest. Maybe you could talk a little bit more about some of the momentum in that segment and how we should think about the onboarding of new clients and how significant those contributions might be as we head into 26 and beyond.
Yeah, we're excited about the tech platform and the opportunity set. Main thing I would say about tech platform is that it drives our overall product roadmap for all of our consumer products, and it's done a really good job of that. You don't always see it in the revenue or profit numbers, but the team has done a phenomenal job of being our overall driver of the product roadmap, which has enabled us to innovate and iterate at a much faster clip than we otherwise could. As it relates to the existing business and financial profile, we've seen good momentum, particularly in the customer pipeline of interest. We recently announced the Southwest, United, and T-Mobile deals, all of whom are very large installed bases of consumers, and we're excited about those businesses. It speaks volumes to our technology capabilities if large consumer brands like that are choosing us to provide them with financial services. So we're excited about that business. The evolution and overall arc line of the revenue profile has changed, as has the sales cycle. When we first acquired the Galileo business, it was primarily focused on fintechs, bank-in-a-box type companies, where we would sign up a lot of them and generate decent revenue from each one, but the integration and sales cycle was really quick. That evolved to focusing on more durable revenue streams, larger customers, banks, consumer brands with large installed bases. And we did that because we wanted to create more durability of revenue. We were also benefiting from the fact that following the Silicon Valley Bank situation and First Republic situation, there was a lot of regulatory pressure for folks to get better real-time visibility into managing their assets and liabilities. We were in a prime position to be able to offer those types of products and services, but the sales cycle and integration cycles are extremely long, especially when displacing, core architecture and core technologies. We're now at an interesting point from a macro perspective where we're able to partner with other businesses to provide financial products and services, particularly in the crypto space. It's much easier to add on and bolt on new products and services within an existing ecosystem than it is to rip out an entire core and replace it. So we view the opportunity set bigger than it ever has been, and really proud of the team for the progress that it's made in signing up some of these larger customers.
All right, thank you, Chris. This is a great update on technology platform. I'm going to pass it back to Jill to close us out with the final question.
Yes, thanks, Tim. So maybe one last one, just with your capital levels above 20%, could you just provide any update in terms of plans for M&A? Is there anything that's of interest to you that you would potentially deploy some capital?
Sure. So like you said, our capital levels at 20% provides us with significant optionality to explore both inorganic and organic opportunities. We look at a number of assets every single day. There's nothing imminent at this point of time, but we have a ton of optionality, particularly as we're heading into 2026.
Great. Thanks so much, Chris. We really appreciate you joining us here in Arizona.
Jeez, that was funny there at the end. That was the same question that I didn't realize that the audio was going to spike whenever I jumped in. I apologize, but the 20% that they have in their capital ratios is a very important question right now. But Chris Lapointe, I love him. I think he's doing great work. But it's like every single one of his answers were complete non-answers. He didn't say anything that was new material. Stuff like the total size, the $400 billion TAM, that was a little interesting. But you don't need SoFi to tell you that. You can look at the industry in general. And then the fact that they're going to be, spending a lot for home loans, that is maybe a material new piece, but we've already seen that just based on the emails they've been sending and the commentary that they've been saying. We didn't need Chris Lapointe to come out and just say that word for word. So really didn't sound like he was able to say much. Obviously, whenever SoFi's CEO comes on, Anthony Noto, he can say a lot more during these fireside chats. This was a little bit of, whatever. Really quick, just because I'm here, let's take a look at the close. SoFi ended up closing out the day at $29.05, down 1.5%. Dell down 1.7%. Alibaba down 1.9%. C Limited down 2%. Let's check out the Mag 7 names really quick. Meta ended up falling off at the close, 639, down 1.1%. Anyone still adding to that name? Amazon, this one's another one worth, in my books, worth adding to, down 0.9. Nvidia, Jensen, after the 1,000 comments in the chat hours after it's been released, saying that Jensen was on Joe Rogan. I promise you, I saw down 1%. And what else do we have? Why am I blanking? Apple ended up hitting new all-time highs on the day, down 0.7 at the close. Salesforce. Oh, yes. Okay, sorry. Up 4.4%. Let's go ahead and see some of this really quickly. If I can get Salesforce's numbers. Sorry, I was not prepared to do any sort of market close. And in fact, I probably should just pass that on over to Amit. But revenue ended up seeming flat, year over year. Not flat year over year, flat versus expectations. And then EPS beat by roughly 26% is what I'm seeing here. Salesforce reported EPS of $3.25. The consensus was $2.86. Revenue came in, like I said, essentially flat, slightly down. And we're raising fiscal year 2026 revenue guidance to $41.45 billion to $41.55 billion. That's pretty exciting. That is very, very cool. They see a very strong pipeline of potential future growth, is what Mark Benioff said, the CEO of Salesforce. Okay, cool. C3 AI, ticker symbol AI, beat on EPS by 24%, and revenue came in almost exactly flat. Very, very slight beat on revenue, but whenever you look at it year over year, they're down on revenue 20%. They're down on EPS 317%. Okay. Let's see what else. Snowflake. I've never understood the C3 AI theme, to be honest. Never quite got that name. Snowflake is down 6.9%, 7%. Looks like a double beat. EPS is up 75% year over year, beating expectations by 13%. Revenue beat by 3%, up 29% year over year. I have to see a little bit more to realize what's pushing that stock down. I wonder. It could be someone leaving. It could be dilution. What is pushing that down? Could be guidance. Definitely could be guidance. Okay, let's check guidance really quick if I can find it. Snowflake down 6.4. Salesforce up 4.4. C3 AI down 2.4. Snowflake down 6.6. And we also have Path as well. Snowflake and Anthropic announced a $200 million AI partnership expansion, according to Tevis. Thank you, brother. Okay, I just typed in Tevis into the chat bar. Thanks. Okay, UiPath, looking flat, 0.6. Let's look for their earnings as well. Okay. I don't know if UiPath is even out yet. Numbers are expected at 410. Okay, so we'll see that here in a second. I am expecting bullish numbers for UiPath, though. A lot of people have been talking about quite an exciting quarter for UiPath. Let's look at Five Below. And then what else? Encino, which is a Galileo competitor, up 2.2%. Okay. Those are really the important names for today. Let's go through and read a little bit more on Salesforce. See how they're doing. Okay. Operating cash flow guidance of around 13 to 14% year over year. That's for their guide. Q3 they did operating cash flow of $2.3 billion. Let's see. Revenue is up 9% year over year. Remaining performance obligations was up 11% year over year and 11% on a constant currency basis. Agent force sales is up 8% year over year for sales. Services was up 8%. Their 360 platform and Slack was up 19%. Commerce is only up 1%. Shopify is just, yeah. The biggest switch from the commerce platform, the Salesforce Commerce, to Shopify is the biggest two-company difference, which I think is quite interesting. So most customers that are leaving Salesforce are going to Shopify, and the most amount of customers that Shopify sees on their platform is from Salesforce. UiPath up 2.6% now, 2.934%. Yeah, looks like people were right on this name. They had a right to be bullish. Okay. Let's quickly take a look at UiPath. If I can find their numbers, double beat, EPS 16 cents versus 15 cents expected, 7% beat, revenue up 16% year over year, beat by 5%. So two decent beats on that name. EPS was up 45% year over year. Really, really nice and solid there. Okay. For Salesforce, they are up 4% now, trailing back a little bit more. Our Agentforce and Data 360 products at the are the momentum drivers, hitting nearly $1.4 billion in annual recurring revenue, an explosive 114% year-over-year gain. We now have more than 9,500, wow, paid Agentforce deals and 3.2 trillion tokens processed, underscoring our leadership in building agentic enterprise and driving real outcomes, said Mark Benioff. That is quite the increase there. That's exciting. Our Q3 momentum and continued Agentforce adoption further reinforces our path to achieving our $60 billion plus organic revenue target and our profitable growth framework target of rule of 50 by full year 2030. Yeah. If you end up looking at the company based on that 2030 guidance, they are extremely cheap. It's just a matter if they get there or if you would rather play something like Palantir instead that has a much higher valuation, but also much higher cost. UiPath, let's see if I can find this one. So as we said, revenue is up 16%. EPS looks like it's up 45%. Annual recurring revenue is up 11% year over year, and the gross margins are at 85%. Guidance came in as expected at $462 million for Q4, and annual recurring revenue of $1.85 billion. Their net new ARR was $59 million and had a net retention rate of 107%. Not bad. Not bad. We like to see it. I'm pleased with our third quarter results, driving ARR to $1.78 billion, up 11% year over year, a testament to the team's focus, consistent execution, and the momentum we're seeing as consumers scale agentic automation across the enterprise, said the founder and CEO, Daniel Dines of UiPath, now up 9%. We delivered strong Q3 results, exceeding guidance across the board and achieving our first GAAP profitable third quarter, said the COO and CFO of the business. Enterprises are accelerating their AI and automation strategies and are looking for a unified platform rather than standalone tools. Our ability to bring demonstrate, oh my gosh, that's a hard word. Demonstrating automation, agentic automation, and orchestration together in one trusted governed system is a true differentiator. Wow, way to struggle through that, Tanner. But we got there. Guidewire also saw double beats. GWRE. down 4.4% on a double beat as well. UiPath up 10% now. Holy crap. 10%. Snowflake down 5%. Salesforce up 4%. 248 on Salesforce. That's pretty exciting. Okay. Ladies and gentlemen. No SoFi Fireside reaction then? No, I gave you my reaction. I didn't, like, that was nothing. There was nothing to it. They said nothing. They gave us no new information. It was boring. Yeah. But ladies and gentlemen, this is not what's going to usually happen. We just had to shift it over because of those fireside chats. But if you guys are interested in following along on this investing journey, try to learn together, then make sure you subscribe. The Future Investing Cult is growing, and yeah, we're looking for innovative companies that are growing. We're not setting price targets. We're not trading. We're investing long-term based on companies that are growing extremely quickly. Robinhood's numbers, we just found out, are going to be dropping on December 10th. That'll be their November numbers. December 10th. That'll also be roughly the same time that we get monthly website traffic as well for all the big fintechs. So we'll probably see website traffic and their trading volume. And we'll also see that for, SoFi and Chime and all of those as well. Thank you all so much for watching, but bye for now.